Hello, everyone. Welcome to the first lecture of AFM of the Strategic Professional level of ACCA. This is Anushka Jain, your tutor for the subject. I'll give you a brief introduction about myself, and then I would like to know a bit about you and yourself, what you are doing in your career, where you're educationally qualified. Okay, so let's start with me. I am a chartered accountant and also an ACCA affiliate. I have more than 5 years of work experience in corporates, and I'm currently working with a leading e-com company in Bangalore. I qualified as a CA in 2017 and as ACCA in 2019, post which I have been teaching ACCA students. So this is my AFM batch with you all. I hope you all enjoy the journey. We make our classes really interactive. Your chat box is your window to talk to me. I entertain every doubt which comes along there. And if you have ideas to share, how you have known about this concept or something about the world, which we will keep on discussing. So we keep our classes, very linked to the practical world. So that is how the class structure goes. Okay. That is about me. Can you quickly tell me about yourself in the chat box, what you are doing, where you're working, or if you have an education qualification, professional one, to, as we speak. A very brief introduction, please, so that I understand where you all are standing and, I can decide the curriculum accordingly. Samsung is what is coming as your name. Can you please quickly change it to your name? Or you can tell me your name so that I can call you out with that. Vinayaka. Okay, Vinayaka, you can tell me about yourself. Others also, please start typing in the chat box. Want to know all about you. Hey, Pavan. Hi, Simmerpreet. Hey, Ramanujam. Ramanujam is a CMA and a CS. He is working for a listed entity in Chennai. Great, Ramanujam. I'll call you Ram if that is okay with you. Hey, Pavan. Rupanshu says, I am also a qualified chartered accountant and currently, just a second, I need to increase the chat box. With one of the big four in FDD. Great, Rupanshu. I hope you're having a very good time. Next, we have Niranjan. He is also a CA and is working in the manufacturing industry. Great. Ayushi is pursuing CA and ACCA. That's great, Ayushi. Vinayaka is also a CA and is working in Intertrust Group, supporting UK in accounting and reporting. Oh, wow. So we have a lot of CA, CS, CMA, and some are pursuing, some are qualified. Simmer says she has qualified as a CA intern and she has rejoined again now. Simmer, I really appreciate your courage to start off again, telling you very frankly, professional qualification gives you an edge in your career. It's great that you have decided to start back again, and I will do my best in my power to help you support in your journey to qualify as an ACCA here. Okay. Also, one more thing which I would like to know from you all is AFM your first paper, or you have taken coaching of any other paper, or you have appeared for AFM before, just to get an idea, or if this is the first paper you are going to appear, you're new to ACCA, because some of you who are CAs, I am sure you would have taken exemptions and you would have come at the strategic level directly. So if you are at the strategic level directly, is it your first paper or how is it? Can you tell me? Rupanshu has already cleared SBR. Great. So this is the second exam. She has cleared skill level and attended class for SBL. Okay, Ayushi. Vinayaka is new to ACCA and AFM is his first paper. Pawan says, given 2 papers of professional level. You got the results for them, Pawan? Sahil says it's his first paper. Ramanujam has cleared SBR and SBL. Okay, great. So it's his first time that he is taking AFM. Okay. Simar had appeared for AFM in March 20, but couldn't clear it. I have cleared SBR last March. Okay, great. So I understand that you are a bunch of mixed, students. Some have appeared for an exam, some have cleared, some have also tried for AFM. So now I get an idea of what the batch looks like. So with that, okay, so just to reiterate again, the chat box is open. Wherever you feel, ma'am, it's not, I'm not able to get it, be as open as possible. We are here to help you out. So just make use of the chat box and I'll try to solve all your doubts. Okay. So let us begin. I will first give you an introduction about the AFM paper. I understand most of you are taking up AFM for the first time, right? So it's important to know about what AFM is, Advanced Financial Management, right? So where it stands in your journey to ACCA, becoming an ACCA, what linkages and what pre-acquired knowledge you're supposed to have when you're taking up this paper, okay? So the overall aim of the syllabus, it is, to have you put in the place of a senior financial advisor in a company, okay? You are going to be put in the shoes of a very senior, maybe a CFO or, very high professional, at a very high level in a company's hierarchy. And you will decide what the company should do in the time to come. So that is where AFM is. I know most of you are already qualified as CACS. I am also a CA and an ACCA. So now let me tell you from experience, ACCA requires a lot of professional judgment, much more than that is required for in a CA. Curriculum wise, it is a little different also. Some topics, there are new, they're dealt with in a different way. So that is the difference you will see in us as well. So be engaged, grasp as much as you can the classes itself. My duty is to ensure that everything gets done in the class so that you are just left with only practice work. You don't have to go through any other book. So for the purpose of our classes, what we do, your slides become one reference point and you will have to do practice kit, which is the kit of BPP, okay, in your home, so that you can practice, and if there is any doubt you have, you can quickly ask them in the next class. Okay, so I'll keep on giving you homework. There are going to be lots of homework, so be prepared with that. You will have a good time. Okay, so with that, now let me again tell you that you are going to be put in the shoes of a very senior financial advisor in a company and then give out decisions as to what will be done in that particular question. Okay, the brought forward knowledge, yes, it requires a lot of things. It will be assumed you know certain things from the financial management paper. So those who have come from the skilled level, those who have studied skill level financial management paper, it is fine. You will obviously know about the syllabus, what you have covered. And those who have come to the strategic professional level directly, being CAs or having qualifications which give you exemptions from appearing in skill level papers, for them also I would like to tell there are some things which will be assumed but in my capacity, wherever possible, I will try to help you out with those little topics as well. But please try to have that prior knowledge, whatever professional qualification you have, just do not come out with an open slate. We will try to cover as much as possible, but yes, something basic will be expected because that is how the level is created, right? Okay, so let's understand the link with other exams. So as I told you, at the skilled level, we have financial management paper, and at the knowledge level, we have management accounting. So that is how the hierarchy goes to come at the AFM level. Okay, and it will also, so it is always recommended that you have SBL either done before or you have some basic idea about SBL. That is the curriculum's requirement. But what I try to do to ease it out for my students is I will take up that charge for those who have not done SBL or who are not aware about SBL course at all. I will take up that onus and make sure you are true with AFM just with my classes only. Okay. But that is the course's requirement to have understanding of the SBL paper as well. But not a worry if you haven't appeared for it or if you're not planning to appear for it. SBL is a little different from a lot of other exams. So it's okay if you haven't appeared for it. I will take it in my ownership to help you clear AFM, even if you do not have any knowledge of the SBL paper. Okay. Now, what my expectations are from you when you are attending AFM classes with me. Please follow these small little points. It will help you to succeed in your exams and also in your career, and make it really practical oriented. The classes are really filled with examples in the practical world. So this is what I expect bare minimum from you. So please be regular in the class. Okay. You miss out one class, then you come for the next. It will not create a link in your mind, right? So be regular in the class at all times. Number 2, preferably use laptop while attending the classes. Okay. Do not go for mobile. It's not possible to understand lectures from a mobile or something like that. But that is what the preference is. Try to use laptop, because what I will do, I will give you some classwork, together when I'm teaching you. So you'll have to open up Excel on your laptop and then perform the calculations there and give me back the answers. Okay. So try and use a laptop, and with laptop, open up MS Excel alongside, where you will be performing all the calculations. See, it is going to be a CBE, right? Computer-based exam. So it's important you're geared up for that. I don't want you to use pen, paper, or calculator. Even if you're making self notes while I'm teaching you, for a particular topic, you feel that this is what ma'am is telling, I can note this down. So make sure you're doing all of that digitally. Become accustomed to laptops, typing it in, laptop, performing the calculations in the MS Excel. This will really help you out. Okay. So use MS Excel to perform all the calculations. No pen, paper, and calculator. I know we CAs, when we are doing CA, we become so accustomed to a calculator, tuck, 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 and we are done with all the calculations. Try to get out of that. Use MS Excel for all your calculations. You will be saving time, right? Next is attempt all the homework questions. You will enjoy, okay? First. Second, you can clear your doubts immediately in the class. I gave you a homework on Saturday. Maybe you couldn't do it in Saturday itself. You do it on Sunday. Then the next Saturday, you can ask your questions. So that is how it helps you, and others also. Those who have not solved, they'll understand, yes, this particular concept was, a little difficult in the question. We learned it in the class. So it's, plus for both sides win. So attempt all the homework questions. Raise queries in the chat box wherever you are stuck on any points. Conceptual clarity is extremely important for me as well as you. So I request you all to make use of the chat box. Put in your queries. It's okay if you're asking a silly question, not a problem. We all are your students here, right? So you don't have to worry if this is a silly question, not a problem. You can ask the basic of basic questions. It's okay with me, right? So these are my expectations from you. Be regular and, just keep it interactive. I don't want it just one-to-one class. I want it both ways, right? Two-way street it should be. Now let's come to the exam pattern. Any doubts from the previous slide? Can I, come to the next topic where I'm going to discuss the exam pattern? Is it good to go ahead? Great, Ram. Okay. So exam pattern, it's going to be a computer-based exam. Okay, so you'll be sitting in front of a computer. The questions will be shown to you on a computer screen. It's not going to be like, a physical exam. You might have appeared for physical exams in CA or other papers wherever you have appeared. But ACCA is completely computer-based. That's how I have designed my classes as well. Exam duration is of 3 hours 15 minutes. Okay, you are free to use your pen and paper, I mean your computer and these during this time. Okay, 3 hours and 15 minutes. Basically it's 195 minutes, right? 3 hours and 15 minutes is 195 minutes. Pass mark is 50%. Here is the key. See, I got world rank 2 and all India rank 1 in my attempt when I went for the AFM paper. I'm telling you from a very as a friend here, it was not as if I had done something really exceptional that I solved the book thrice, 4 times, not like that. It's just that my conceptual clarity was on point, because don't expect any type of common question in the exam. Okay, I scored a very good mark because I could write well. My presentation skills were very nice. My conceptual clarity was very nice. So that is what helped me to achieve this world rank, So please ensure, yes, the pass mark is 50%, but you have to aim for the best. If you are regular in the class, I'm assuring you, getting a rank is not that difficult. Just ensure you are very clear in your mind. It will help you out. And also practice is the key. Yes, when I say how my preparation went and how I ask my students to prepare, is to have, I'll keep on telling this point. It's not just restricted to the first point. By the time you are in classes, you will be through with these small little mantras I keep giving. So when I teach you something, have a very brief reading of it after the class. I share all my notes. Okay, so have a very brief reading of it after the class, and then sit down with the PR kit, take up any question and solve it on computer, guys. Okay, just in a rough sort of way. That is the first time you are doing it now. You are free to look at the book's answer. But when you are doing that, what you should do is basically highlight the points where you got stuck. Okay, where you could not think that this is the approach I should have followed. So that the next time you practice that question, you should be able to do it on your own without looking at the book. Okay, so my approach was to solve the entire PR kit once without actually, thinking much. I used to have a look at the answer and then frame my mind. Second time I did it, and also during the first time I used to mark up the places where I got stuck. And when you spend time on the point you got stuck, it stays with you. Okay, you are judging yourself. That is how professionals do, right? There's not going to be a supervisor on you all the time. You have to be your own judge. So you should judge that this is the point where I got stuck. Let's mark it. The next time I do it, I have to check whether I could remember that concept or not. Okay, so that is what I did. First reading of the book was a mere story type of reading, where I used to read the answers and then frame my mind. Yes, this all is covered. Second time I did it, it was completely on my own. And second time, if I'm getting stuck somewhere, it means there is some conceptual clarity which I'm lacking. I used to read back the concepts again. Okay. And then third was, practicing only the important questions. Some things, there are some questions where you feel that if you do not read it before the exam, and if it comes in the exam, you'll not be able to solve. Okay. So we all are aware of that. So we are, have appeared for some exams in our lives. So we know that there are some questions, if you don't look at it before the exam, it becomes really difficult, right? So I used to mark those questions and practice them only. That is what my exam preparation strategy was. And I expect you all, and I recommend you all as a friend here, that you also adopt this approach. When you are doing the classes, read the notes and do a bird's eye reading of the homework. Okay, so it's like the book is not structured in like question 1 belongs to chapter 1. I will give you the questions to read out at home. That is what you should do. Okay, it will help you out. Fine. So yes, I started off with the pass mark being 50%, but that's not the benchmark you should set for yourself. Aim high, aim for a rank. I'm telling you, it's going to be a lot of opportunities when you do that. Okay, so yes, that is what the approach in our class is going to be. It's not just to pass, but to pass with flying colors. Okay, yes, in the exam, all questions are going to be compulsory. Every question. So you're going to get 3 questions. I'll give you what the questions, tell you how the questions look like. All questions are compulsory. 3 questions. questions are scenario based. Gone are the times you will be given with data directly and you have to apply a formula, solve it. No, that is not what is expected of you at the strategic professional level. It will be a scenario. They will give you a situation. They will try to put you in a particular place that this is what the company is experiencing. Give your ideas. Okay. So questions are scenario based. You'll have to read a lot. You'll have to mark up important stuff. With so much of data, I'll show you what a question looks like. And you will realize that there is so much of data. If you do not highlight important stuff when you're reading it, you will be lost by the end of the question. You started off somewhere, you'll end up somewhere and you'll be like, what just happened? So questions are scenario based, big questions. You need to keep on marking stuff, the data which you will be needing to solve the calculations, right? So please try to understand that. And yes, as I said before, adopt the role of a senior financial advisor in a company. Think yourself that you are now an advisor. You're not just a normal accountant, you are an advisor to the company, a financial advisor to the company to help them make their financial decisions. That is what you should try to do. Okay, so are we clear? Any doubts here? I'll keep asking for these questions so that you can just give me a quick yes, and then we will move to the next one. Ayushi is asking, is it like SBL paper? So in SBL, there is just one question of 100 marks with a lot of subparts, right? But in AFM, there are going to be 3 proper questions. I'll come to the next slide and I'll show you. Okay. So there are going to be 3 questions. This is the format of the exam, right? So there are going to be 3 questions with section A and section B. I'm answering Ayushi's query as well as for all of you. Okay, please listen to this very carefully. So in the paper, the first question is going to be of 50 marks. It might come to you all as a surprise that how can a question be of 50 marks? What are we going to do that it's going to give us 50 marks? There are going to be subparts of this question, okay? Like question number 1, then part A, part B, part C, like that. But yes, one situation only, and all of those questions will be based on that situation. Okay, so question number 1, it is of 50 marks. And let me tell you that in this 50-mark question now, 4 marks are only for your professional skills, as in how you are writing your answers, whether you have structured it nicely, whether a layman who is just a shareholder of the company, if he reads your report, so it's a report-based question. You have to basically write down a report for the directors or for the shareholders. Whether that person who doesn't have any prior knowledge of finance be able to take decisions on the basis of the report you have given out to him. You get free 4 marks. No question is specifically asked for those 4 marks. Just the way you present, just the way you convey your thoughts. So that one question is of 50 marks with 4 marks of professional marks only, right? So that is about the first question in section A. Then comes section B. Section B consists of 2 questions of 25 marks each. Okay. Smaller questions, of course, than the 50-mark questions. But yes, again, there will be a scenario. You have to judge and give out your decisions. Is it okay, everyone? Ayushi, have I answered your question? So are you able to make out a difference between SBL and AFM now? SBL is just one question of 100 marks. Here you're going to get 3 questions, 1 of 100 marks, then 2 of 25 marks each. Okay, so all topics. So there are going to be a lot of chapters which you will be studying along with me. All of them are examinable. It's not like one topic is important, another is not. Anything can be asked in the question. Okay, that is the bare minimum you can expect. But there are 2 chapters specifically where I lay specific focus, and that is I'll get back to you on that, Rupanshu. Okay. So these 2 topics, right, in section B and section E of the book, okay, I mean, as the curriculum flows, which is advanced investment appraisal and treasury and advanced risk management. These 2 questions, there is a definite chance of a question coming from this topic, be it in any section. Okay, so it could be in section A or it could be in section B, but yes, there will definitely be a question from these two topics. So these are really important for you all. A mandatory question comes from these two topics. Okay, again, attempt the paper in any order in which you are comfortable. Okay, it's not like you have to attempt the first question first, second question later, nothing like that. You are free to attempt in any order. You can answer question 3 first, question 2 first. That is not a problem. But within that question, what you should do is have, each sub part answered in that order. Don't go like question number 1C first, then 1B, 1A, not like that. Whenever you're answering any question, each of the sub parts should be answered in that order only. It shows your professional way to the question. Okay, so adopt that approach. Any question you can pick up first, and then sub parts you should appear in that order in which it has been asked. Okay, so are we clear on this? And yes, formatting, I will lay a lot of emphasis that you should give a proper heading, that answer to question number 1, then A. Keep it spacious. Okay, do not try to put everything in just one cell of Excel. Not like that. Try. I'll teach you how to do that. Make small notes and give reference to those notes. Make your answers as crisp and clean as possible. Okay, so are we good to go ahead on this? Section A is question number 1 of 50 marks. Section B is 2 questions of 25 marks each. And yes, 2 topics, really important. One of them is investment appraisal. I think you all might know concepts of, like, those who have studied CA, NPV, IRR, MIRR, all of those questions get covered in investment appraisal. And second is treasury risk management. It is basically about hedging, the derivatives chapter, which you call in CA curriculum. And those who are have not done CA, not a problem. I'll teach you at a very basic level. So are we good to go ahead with this? Okay, great. Now what I'll do, just give me a moment. I will open up questions for your reference, how a question looks like. When I tell you that the questions are scenario based, just to give you a brief idea how a question looks like, I'll open up the BPP module. Okay, everyone, please buy BPP kits. So whenever you buy a BPP book, you will also get access to an ebook. Okay, I'll show you any one mock examination. Okay, so that is how the question starts off, like advanced financial management. Then they will write the attempt. And then comes the first question, section A. This question is compulsory and must be attempted. As I told you, all questions are mandatory and it is important. See, now you know that 50% is the pass mark, correct? If you are there in the exam and if you have decided you want to pass, can you tell me? It's very logical. You have to attempt for each one of the questions, then only you'll be able to pass, right? Each of the questions are mandatory. You need to attempt all of them to get the bare 50% marks. Okay, so let's have a look at how a question looks like. I'm not going to read out the question for you, it's just to show you how it really looks like in this 50-mark question. they give you exhibits. Exhibits are small pieces of information about a particular topic. Like now they've given you the introduction to the question. Okay, they'll tell you that this company is doing what it is, its aim is this. They'll try to create a story around this question now. Okay, and within this question, these lines, there will be some hidden pieces of information which you'll have to pick up and put in your answers. Okay, so that is what exhibit 1. So it's not like there are going to be 5 exhibits, not fixed, but something like that they will put in the information. Like, okay, then now they have started to talk about Metaverse company. Now, a question here. See, now the financial piece of information has started from here. Okay, so what the profit is, how much loan it has taken, how much share capital it has. See, now all these lines are starting to contain some bits and pieces of information. What the market value of the share is, how much premium the shareholders have to pay, all of this 15%. What I used to do was to highlight this stuff while I'm reading the question itself and write in my own writing. I had appeared for a physical paper. So I used to write in my own handwriting that this information is covered here. You can do the same approach while you're doing the computer-based examination. You are free to highlight in the question, okay? In fact, there is one added advantage for you all. You can copy the text from question in your answer. You don't even have to read that much. Financial information, like the important tables, the big ones, not small pieces of information like this, but the big tables, they give in Excel only. You can copy the entire Excel data and put it in your answer script. You don't have to waste time on typing stuff. At least what is given in the question. That is one added advantage for appearing in computer-based examinations. And of course, Excel is a boon. You don't have to learn IRR formulas or any typical formula. It's just Excel will be able to give you the answers. So that is the benefit of CBE. Yeah, coming back to the question. So now you see, right, how much information they give you. They've given in the story, no direct presentation of the data. You have to pick up the data, right? Now the data, question goes on and on. So much information, asset beta, rate of return, all of that, okay? Plans for Metaverse, exhibit 5, and then comes the requirements. Okay, let me tell you very frankly, do not start off with the first line of the question first. When you're reading now, read the requirement first. Without having any idea of the question, read the requirement first. What the question is going to ask you, NPV or acquisition, mergers, anyone, okay? Just read the requirement so that when you actually read the question, the exhibits which they have given to you, you will know that this piece of information is going to be useful for me in performing this particular calculation. Your mind becomes alert at that time. So requirement first every time, not just for 50-mark question, but for 25-mark questions also. Read the requirement first. What is being asked? Okay. And then you read the main question. So now you have read the requirements, discuss the behavioral factors which may have led to the businesses such as Metaverse Tech being valued highly. Okay. Do you understand this is a theory question? Proper theory question. The information you have to pick from the exhibits. What all factors? Now, if you do not read this question first, tell me very frankly, don't you think you'll have to read the entire question again to decide which all behavioral factors have led to the business to grow, to be valued highly, right? But if you follow this approach of reading the requirement first, in that case, your mind has already become aware that when I'm reading the question now, I will have to pick up these important points for my answer. Otherwise, keep on reading again and again. You'll waste time reading. There is no marks for reading the question, let me tell you. You have to write, right? So read the requirement first and then go for the question. This will help you save your time. Time is always running short in AFM papers. There are so many questions, so many data. It becomes a challenge to complete the entire paper. So read the requirement first, then go for the question. Okay. So prepare a report. Again, I told you, right, that it is a report that will be asked in the question. So report for the board of directors. Think you are the CFO or maybe a very senior financial advisor for the CFO. You have to prepare that report. It's not like you will just, throw data at them, just have a look at this data. I don't care whether you understand or not. No, you are preparing a report. It's your responsibility to make your readers understand what you're trying to convey. Okay, so have a very good formatting, have a very good way to convey your ideas, what your decision is, how you have arrived at that decision. Okay. So sorry. So you have to prepare a report like that. Then, so again, see, I told you, right, there are going to be sub parts. So this was part A, then part B. Within part B, so there is just one question in which you have to prepare a report, but they will specify what all needs to be covered in the report. You can put extra things, not a problem, but this all things, reports should be including comparison of the additional value, all of that. We'll start learning about these things. Then these 4 aspects at least should be covered in the report. Okay. And finally, as I told you, professional marks will be awarded in part B, only for part B, for the report presentation only, for the format, structure, and presentation of the report for 4 marks. I hope you understand the importance of your formatting, presentation for this particular question only. Let me be very specific. It's not for the entire paper. It's just for this question. And part C, now they've given the third part, discuss the factors which may determine how the offer for metaverse will be financed and hence the level of gearing which this company will have. Now, do you realize that this is not a pure theory question? It's a mix of theory and practical. Again, all the questions are mix of theory and practical mostly. So that is how the question goes. So if you have read the requirement, first go for the question. That is number 1 trick. Number 2, keep on highlighting the important stuff in the question, because there will be so much information you will get lost otherwise. Okay. See, the very reason I'm showing you the question paper in the first class itself is to gear you up for the reality. I don't want to tell you that it's going to be an easy paper. It is not. You have to become accustomed to writing long answers and all of that. Okay. So that is the reason I'm showing you the question. Then 25 mark questions, they are obviously smaller than the 50 mark question. I'll show you just one 25 mark question. So here also, they will give you exhibits, exhibit 2, exhibit 3, like that. Then this data is given to you. It's a question on, see, this one I told you, right? Hedging, they will ask. One question will definitely be there on hedging. So they have asked in this 25 mark question. For currency option details, they have given. Okay. Again, this is also a very long question. Not a small question, I would say. And then the requirements are given to you. Requirements are here. Read them first, then go for the question. So the question, 50 mark question spans across 3-4 pages. This one is across 2 pages, max to max. Okay, that is how the question looks like. Here, okay, let's start with the curriculum, and then I will keep on telling you the points for each specific topic. But that is how a question looks like. Are we good? Any questions on a question, how it looks like? I mean, you want to know more about something? Or we can move and start off with the first chapter of the curriculum. And if you feel at any point that I'm going a little fast, you can let me know that I'll slow down. I have been teaching for many years, so now I know what the pace of students is. But sometimes a student feels that, this topic is difficult. I want the teacher to slow down a little. That is also okay with me. So you can always let me know. Otherwise, is it okay with you all? How question format looks like? How much subparts will be there? Is it okay? Great. So I'll come back to my slide now. That one is done. So I'll start off with the first chapter. Okay, guys, so let's now formally start our syllabus, and it is going to be Financial Strategy Formulation. That's your chapter number 1. Okay, I didn't tell you about our classes, so it is going to be 4 hours, like from 10 to 2 on the weekends, Saturday, Sunday, and you'll get a good 20-minute break in between. So don't get worried how I'm going to study for the span of 4 hours. So you are going to get a 20-minute break in between. At normally I give it at around 11:45 onwards, 11:45 to 12 I normally give a break. Okay, so yes, now let's quickly begin the first chapter, and that is Financial Strategy Formulation. Okay, this concept, which is the maximization of this now should be embedded in your head forever for your entire professional life. You are here for the shareholders. You have to create value for the shareholders. Okay, see, you are hired by the managers of the company, by the directors, but please do understand it is the shareholders who began the company, who put in their hard-earned money in the company and started it off. Even the directors, the managers, they're all hired by the investors, by the shareholders, correct? So when you are taking any decision that has to be from the point of view of a shareholder, that if I'm okay, so maximization of shareholders' wealth. Do not think what the directors will say, what the employees will say. That is not your concern. Your concern are your shareholders. Okay. So investors or shareholders, they're one and the same thing. They care about future dividend. Dividend is as in the distribution of the profits, right, to the shareholders. So they care about the future, how the company is going to shape up, what the company plans to do in the future. Dividend, financing plans. Now, when I say financing plans, it is basically the structure of debt and equity in the company. How the company is going to be financed. Okay. Financing plans and risk management. Risk management, there are always 2 types of risks which a business faces. It is number 1, business risk. Number 2, finance risk. Business risk is specific to a company. Okay. It is like, so imagine FMCG companies in India. Can you quickly give me examples of big, FMCG companies in India? ITC, Pepsi, HUL, correct? Right? Then you have got Dabur. So these are all FMCG companies. Dabur, HUL, ITC, these are all listed also. So these companies, they're in a particular industry. And because of being in that industry, there are certain risks which each one of them faces. Right? Yes, Prabhash, you have something to share? You can put it in the chat box directly, okay? Yes, so I was saying that these companies, they have a set of risks which is prevalent across the entire industry. Now, what could be the risks for an FMCG company? If they are in the FMCG industry, what are normal risks it faces? Hi, Chotu. No worries. We have just started off with the first chapter, Chotu. We covered the exam pattern and how the question looks like, how you should really prepare for AFM. That is what was covered till now. This is the first chapter we are starting. There will be a proper recording of the class which should be shared across. So no worries, you can always look at it later. Okay. Yes, so I was telling, what all are the risks which an FMCG company normally faces? Ayushi says change in market condition. Yes. Competition. Right, Ram? And then there could be change in customer preferences. Okay. Today, the customers have become more aware of, their health. They don't like eating a lot of calories. So this is a threat, something which all the companies in this particular industry is facing. How to create something which the customer readily accepts as a healthy option, right? I believe all of you are now in that same boat, that you feel that today, because of so many diseases and so many illnesses which are prevalent in the world as a already there, why not adopt two healthy practices which make you live a healthy and a long life? So this is something which each of the company in the FMCG industry faces, right? So this is known as business risk. Because you are in a certain business, you are exposed to certain type of risks. You cannot avoid that. Okay, that is known as business risk. Second type of risk is finance risk. Finance risk meaning how your capital structure is. See, mostly capital will be in what? Debt and equity, right? Tell me, is it a good thing to have a lot of debt in your company? If not, why? What can happen if you take up a lot of debt in your company? There is always a risk of default. Very good point, Harshit. That is risk of, yes, Ayushi, right. That is the risk of bankruptcy. You have taken so much debt that ultimately you will be just left with paying interest, and you will have nothing to actually work on your operations. Okay, so having a lot of debt is not preferable, and that is why it is known as finance risk. How you have financed your company, whether you have equity, whether you have debt, that mix is also important for the investors, because ultimately they put in the equity. Equity doesn't have any guarantee that if you have put 1 lakh rupees in the company, when the company shuts down, you will get 1 lakh rupees. It's not like that. Your money can become zero. So investors, they are concerned with these two types of risks. When I say risk management, it is actually how the directors are managing the finance, the capital structure of the company, split between debt and equity. Okay, so investors, they care about the future policies of the company, how much dividend they are going to earn, what the financing. Okay, wealth maximization and not profit maximization. Please understand that both these terms are different. Wealth maximization and profit maximization, they are different terms. And when I say you are working for the shareholders, you are concerned with maximizing their wealth and not the profit of the company. Okay, so wealth maximization and not profit maximization is the primary objective of business. Can someone tell me, how is wealth different from profit? What do you think is the difference between wealth and profit? How can you grow shareholders' wealth? When I say maximize shareholders' wealth, what will you maximize, which will help them to maximize their wealth? Absolutely right, Harshit. Wealth relates to the market capitalization, or in simple terms, I can say increase in the share price. Yes. So when the investors put their money, the shares were trading at, let's say, 200 rupees. Now, with all the initiatives which the management takes, with all the goodness the business is bringing, the share now trends at 350. Okay. This is a growth in the wealth of the shareholders, because their money has multiplied from 200 to 350. Right? They're not concerned with how much profit the company is making, but they just perceive the value in the increase of their share prices. If not share prices, they also see what is the dividend they are earning out of those shares. Okay, so if you are active in the share market or something, you will realize that there are two types of companies mostly. One is which retains all the profits, never pays dividends. Okay, these are all topics in your curriculum, and at that time point, I'll give you more detailed examples. But now, just it's the first slide. I'm giving you brief ideas. So there are some companies who retain all the all the profits, they do not distribute them. And there are some companies who rely more on increasing the wealth of the shareholders by distributing dividends. Correct? Can you tell me one example for each kind? One which focuses more on dividend distribution, one which focuses more on profit retention. Very good, Ram. That is correct. ITC is an example for a dividend paying company. Every year, ITC releases approximately 10%, mostly it ranges between 8 to 10% of the share value as dividend throughout the year. So you can understand how much goodness it gives out. So if you invest in an FD today, you get interest about what? 6% max. But if you have invested in the shares of ITC, just from dividend, you're going to earn bare minimum 8 to 10%. Correct? Very valid point by Pawan that new companies, they go for profit retention. They don't pay dividend. Why is it so? Because they want to be focused on using that profit for further wealth creation. I mean, they are going to use it for developing the business. They don't want to distribute it, right? Each company has two options. Either to see if they feel that they do not have sufficient opportunities to invest it, they believe that the investors themselves can take the decision of how to grow their money, they will distribute the money as dividend. But if the if the company believes that no, we have got a lot of fruitful opportunities in front of us, why not we put the profits in those projects and make higher profits from the business overall, which ultimately belongs to the shareholders. Okay, so they think that in the long term, let's just make profits now. In the long term, all the profits will go to the shareholders only. Correct? So these are the two type of companies which are normally prevalent. New companies, in fact, Reliance, I will say, Reliance is an example of a company which never pays dividend. Have you ever heard of Reliance paying out dividend? I have never, and it has never happened. Reliance is not a company which pays dividend. It has got so many opportunities in front of it now. They will put the money in those opportunities rather than paying the money as dividend to the shareholders. Whereas ITC, it is a cash-rich company. Because of the type of businesses it is in, it makes a lot of cash. Okay. So ITC's business is primarily divided into three parts. Okay. You can type in the chat box also what you believe. I'll also tell you. See, number one is hotel. Number two is FMCG. And number three is tobacco. Correct? Cigarette or tobacco. These are the three types of businesses which ITC is in. It's a very cash-rich company. So what it does, whatever profit it makes in cash, it tries to give it out to the shareholders as dividends. Whereas Reliance, it is always in the lookout for investing the extra profits which it makes in the projects which it has, which it has in front of us. So that is how it goes for different type of company. There is no strict rules in finance that if you are an FMCG, you should do this, you should do that. It all depends on the company's ideologies and how it wants to reward its shareholders, whether it wants to reward it in the form of increase in the share price or whether it wants to give out dividends. Okay. So investors care about future dividend financing plans and risk management. Now, each one of these terms will start to make sense to you. It's not just plain reading. Now you know the story behind each of these terms. Correct? Yes, Pawan, that is the reason Reliance doesn't pay dividends. So Pawan says that Reliance is diversifying in various business sectors. Name a sector and you will find Reliance in that. It is fighting battles on each front. Okay, so it entered e-com via Agio, right? AJIO, Agio. It is prevalent in the telecom industry, right? It is the leader there. Then it is in supermarket stuff also, Reliance Fresh. So, everywhere you will find Reliance. Either it makes acquisitions, it acquired Hamleys. So, it acquired such a big chain. It wanted to enter toy industry. So, it is fighting a battle on each front. It is diversifying so much, whereas ITC is restricted to just three businesses, right? Reliance, it is expanding. So it needs money for those acquisitions, right? That is the reason they do not pay dividends. So yes, Pawan, you are right when you say that. Okay. So now you understand, right, the difference between wealth maximization and profit maximization. Wealth maximization is basically increase in the shareholders' returns via either dividends or via increase in share price. Whereas profit maximization, it is an accounting profit, which it is talking about. Shareholders are not really concerned with how much accounting profit a company is making. Okay, so wealth maximization and not profit maximization is the primary objective of business. Clear? And please ensure you remember this for your entire lives now. You are always working for the shareholders of a company. Okay. Next is, how can you measure wealth maximization? How much wealth have you really made for your shareholders? Now, this will come to you conceptually because of all the talking we have just done. That total shareholder return is dividend yield plus capital gain or loss. Okay. So in the case of ITC, the dividend yield will be very high, whereas capital gain is what? Increase in the share price as on 1st April versus share price as on 31st March of the next year. How much the share price has increased over this 1 year. That is considered as capital gain, correct? So dividend yield is basically what the shareholders are getting as dividends. Capital gain is increase in the share price. Got it? These are the two ways by which a shareholder gets return on the money which he has invested in the shares, correct? So any doubts here? Are we clear on this? Okay, great. Thanks for that update. Yeah. So under maximization of shareholder wealth concept, there are primarily 4 parts. Okay. And these are all linked to this just one statement, which I taught for so long: future, dividend, financing plans, and risk management. Okay. Let me show you how you can maximize shareholder wealth. Number 1 is investment decision. Okay. Now, when we spoke about Reliance, what did I say? That it is investing so much in different businesses, right? So it is making an investment decision to increase the shareholders' wealth. So that they are focused more on investing decision. Second is financing decision. Okay, we will learn about it in a lot of details, so I can't really cover it all now. Financing decision is basically debt helps the equity holders to leverage their wealth. Okay, you get tax benefit on the interest which you pay on debt, right? So these are some levers for increasing the wealth of the shareholders in financing decision. How you actually optimize your finance structure, that is what gets covered under financing decision, right? Third is dividend decision. See, if ITC now starts retaining all the profits, thinking that no, I don't want to distribute share value to the shareholders, they are making a wrong dividend decision, right? Because they're cash rich companies. What will they do by keeping the money? So their dividend decision becomes very important. And finally, over all of these covers risk management. Now you know what risk management is, right? It is about managing the business risk and the finance risk overall so that the company flourishes in the long run. It is not shut down because of bankruptcy or XYZ reason, whatever. Okay. So this entire curriculum, you will see mostly all the chapters, they are talking about these 4 topics only. Okay. Investment decision, financing decision. So investment decision is covered in chapter 3 to 10. Financing decision is covered in chapter 6. Risk management decision is covered in chapter 2 and 11 to 13. And dividend decision is covered here. So mostly all the chapters, they talk about maximization of shareholders' wealth only. And that is the reason I laid so much time for you to absorb that you are going to work towards maximization of shareholders' wealth. The entire curriculum is based on this concept. Okay. So let us now start dividend decision. Okay. All the other types of decisions, they will be covered in the coming chapters. But today we are going to start off with dividend decision. Okay. So let us quickly understand what all, briefly, what all each type of decision has an impact on the shareholder. Okay. So when I say the company is taking an investment decision, what does it mean? That whether it wants to invest in a same line of business, whether it wants to make an acquisition in another line of business, like Reliance is doing, right? So what is that investment decision? What is the impact of that decision? If the company is growing, in that case, what will be the expectation of shareholders for the dividend? Will they expect very high dividend or low dividend? Now I'm trying to create a link between the different types of decisions with the dividend paying capacity of the company. Okay. So if the company is growing, if the company is expanding in maybe the same line of business or maybe in diverse lines of business, what do you think will the shareholders expect? Very high dividends or low dividends? Obviously low dividends, right? Because they do not want the company to hamper their cash capital. They want the company to spend on these opportunities, in these growing opportunities, and they can wait for dividend for later. You're right, Ram, when you say that initially they will be low expectation, but ultimately it will grow because they also want return on their shares, right? So what they will do, they will have very low expectations from a company which is growing to pay dividends, right? Next, this is, so basically what did we just discuss? The influence of the investment decision on the dividend paying decision. Second decision which impacts dividend is basically the financing decision. Okay. See, when a company has borrowed debt, okay, when it has debt in its capital structure, tell me from your basic knowledge, can the company pay dividends before paying interest to the debt holders? Can they legally pay dividend to shareholders without paying interest to the debt holders? The answer is no. You all know that. Can someone tell me why is it so? You all know no, but why is it so? Ayush is saying paying interest is compulsory. That's the legal obligation. Pawan says, Harshit says owners are paid in last. Ram says interest is charge on profit, whereas dividend is apportionment. That is what I was waiting for. Absolutely right answer by Ram. Interest is a charge against profit. So whenever you're taking loan, okay, loan is a debt, right? If you go for a bank loan, you will find it written in the loan agreement that interest is going to be a charge against profit. If you are making profit, we have the first charge on that profit. You cannot distribute that wealth to your shareholders, okay, unless and until you pay the interest to us. That is what is meant by charge on profit. And second one, dividend, it is just an apportionment of profit. If you have profit after paying interest, that you can pay out as dividends. Unless and until you have that, you cannot. Okay, so paying interest is the first priority, and second is dividends. So now can you tell me, if the finance structure of the company is such that it has got a lot of debt in its capital structure, will it be paying high dividend or low dividend? It has got a lot of debt in its capital structure. It will again be paying low dividend. Yes, because so much of its profits will already be gone as interest to the debt holders. So that is how financing decision impacts your dividend decision. You have got a lot of debt. So what you do, you will try to cut down on the dividends which you will pay to the shareholders. Okay. Now, this type of knowledge is important for framing little bits of theory questions which come. Explain the factors which the directors of this company should consider before deciding on what dividends it should pay. Now you will become accustomed to it. You will analyze what the finance structure of that company is, what the investment policy of that company is going to be, and then give your decision on how much dividend it should pay. So rather than actually, giving vague answers, now you will start to frame proper answers in your mind that what is impacting the dividend decision. So third factor which impacts the dividend decision is influence of its life cycle. Someone told me in the chat box that new companies, they actually pay low dividend, right? Whereas mature companies pay higher dividends. So why is it so? You all gave me the answers in the chat box only, so not going to waste much time on this one. If the company is new, right, it will have very high demands for its own business. If it is making profit, it will want to put that profit in the business itself so that they can, reduce their reliance on debt. Okay. Today, whenever a company is starting off, it's very difficult to start off a new company on a large scale with just your own funds. You definitely go out in the market, take loans or take funding from venture capitalists, and then you start off the business. So whenever you find that you're starting to make profits now, you will try to repay your debt first rather than paying dividend. Okay. So that when the time comes, when you are free of all the debt, then you can properly decide that yes, now I can pay dividend to my shareholders, or now I can, put in my money in newer projects outside of the area which I started off with. Okay. So yes, Chotu, yes, Pawan, you are right when you say that new company needs money for working capital, for growing, for making big capital decisions also, like capital investments. If you're going to buy a big machine, then also you need that money. Okay. So young companies, mostly startups today. Okay. So if you take the example of any startup, you will not find, if they're listed, they will never be paying dividends. Even if they're not listed, whether they're just incorporated as a private company, you will never find them paying dividends to its shareholders because they're always struggling with money. Okay. Because the business is such today that it is very difficult to come to profits. So when they're already making losses, so you cannot expect them to pay dividends. Paying interest itself becomes a very big challenge for these companies. So yes, young companies, they pay 0 to low dividend, whereas mature companies like ITC, it's a very old company, it has matured, it is aware of how its cash flows look like, so they pay very high dividends. It's a very stable business, right? So they can actually think of paying higher dividends. Okay. So that is what the influence of the life cycle is on the dividend decision of a company. And finally, the fourth point is the dividend capacity. Now, this point is important from practical question solving point of view. So small questions, they normally come on this part. That what is the dividend capacity of a company? Okay. So let us try to understand it with the help of this table now. Yes, Dhruv, you're right. Startups, they are running after value. That what is the valuation? $1 billion, $10 billion. That is how startups are. That is where their focus is. Their focus is not into coming into profits. They're always running after valuations. Okay. So today, Meesho has a valuation of $5 billion. Okay. Flipkart has a valuation of, I think, $35 billion, something like that. So what does it show? That they are very highly valued. But can you tell me whether these companies are in profits or losses? They're all in losses, struggling to make profits. Okay. So obviously you cannot expect them to be paying high dividends. Okay. So coming back to dividend capacity, how do I calculate it? Important from practical question solving point of view. So please listen to this carefully. And this is something which we will be following in a lot of topics. So we'll go slow here, try to cover each one of the points. So you start off with operating profits, that is profit before interest and tax. Okay. So what is the structure of the P&L normally? You have revenue as the top line. Then you have certain operating expenses. Tell me whether depreciation is an operating expense or not. You know about depreciation, right? It is a charge on the value of the fixed assets. So tell me whether depreciation is an operating expense or not. Let's see. Very good answer by Chotu. It is non-cash operating expense. Think whether depreciation is operating or non-operating. Others don't know. We have been studying depreciation since class 11. Dhruv is saying operating. So there is a war going on now in the chat box. Someone is saying operating, someone is saying non-operating. The correct answer is operating, guys. Yes, it is an operating non-cash expenditure. See, what did I tell you in the beginning? That depreciation is a charge on the fixed assets of the company. Can you run your business without having fixed assets? What will you do without fixed assets? If you don't have the machinery, if you don't have the building to work in, you'll not be able to do it, right? So it is important for your operations to have those capital assets, right? If you don't have them, you'll not be able to run the business. You'll not be able to operate. Correct? Now, when I say depreciation is a charge on the assets, why was it that the accountants of the past, they decided on not charging the entire cost of the capital asset in the P&L in the first year itself? Why did they say, we will apportion it across the life of the asset? What was the reason? The reason was simple, that they do not want any 1 year to be actually subjected to the entire loss, because it is a payout, right? You don't want to expense it out in 1 year itself, whereas you will be making money out of it in, let's say, 10 years. So if you have purchased the machinery and its life cycle is of 10 years, you are going to use it for the next 10 years. The revenue which the business is going to be making out of that machine is going to span across 10 years. So why to charge the entire cost of the asset in the first year itself? That will be unfair to the first year. And what it will show, that the company doesn't have any stability. First year, it was tremendous losses. Second year, it made a little profit. Third year, again, it made some purchase of fixed asset and its profits went down. That is now not how it should be. Okay. So please understand that fixed assets, they are not charged to the first year itself. They are apportioned over the life cycle. And yes, they are very much, depreciation is very much an operating expense. Why? Because without having these capital assets, you will not be able to operate. Okay. So are we clear on this concept now? That depreciation is an operating expense, and why we are not charging the cost of the capital asset in 1 year itself? It's very logical, because you don't want to bring down the profits in 1 year itself. You want to share it across all the years when the company is going to accrue the benefits out of it. Okay. So be very clear in these concepts. I'll keep on sharing these little stuff so that by the time we are done with the classes, you're conceptually clear with every damn concept of finance. Okay. So yes, so we start off with operating profit. Now tell me what all operating profit will mean. It will have revenue in the top line minus the operating expenses, including depreciation. Now operating expenses will mostly be your cash expenses for running the operations of the business, be it your salary, be it the cost of raw materials, all of that, right? So all of that will be covered within operating expenses. Your administration expenses, employee benefit expenses, all of these get covered under operating profit because they are necessary for running the business. Without it, the business will not be able to run, right? And that also includes depreciation. So when I say operating profit, it is after depreciation and it is denoted as PBIT, that is profit before interest and tax. Okay, and then we not an operating cost. It's not like if you do not take a loan, you will not be able to run the business. You take a loan because you don't have the money to run the business on its own, but it's not necessary for the operations, correct? So that is known as finance cost and not operation cost. So that is why it is written as a line item after PBIT, okay, or that is after operating profit. So operating profit, and then you do less interest. What you get is known as PBT, or profit before tax. Then you reduce the tax, and what you get is PAT. So are we clear till here? These lines are making sense to you all? Okay, great, Rupanshu. Yes, thanks for the update. Now we are going to start off with a little apportionments which needs to be made out of this PAT. Okay, once you have found out the PAT, then you will see. Acha, first tell me, do you know what preference shares? If you don't know, it's okay. But if you know, tell me, what do you know about preference shares? Why are they known as preference shares? What is they are being preferred on? Right. All of us here are giving the same answer. They get preference of payment of dividend. Before dividend is paid out to equity shareholders, if you have preference shares in your capital structure, you will have to pay dividend to them. Okay, they get preference over equity shareholders in terms of dividend. They also get a preference at the time of repayment of the share capital, but that is not the point of concern here. From the point of view of normal operating years, preference shareholders get a preference over the equity shareholders in terms of dividend. Okay, so what are we studying here? First, let's try to recap that. We are trying to find out what is the dividend capacity. And when I say dividend capacity, it is the dividend capacity for the equity shareholders. Okay, so yes, Dhruv, you're right. That is what I said, that they have a preference at the time of getting their capital back at the time of winding up. Okay, so when we are trying to find out the dividend capacity for equity shareholders, you need to understand that if you are having preference share capital in your company, then preference dividend will be reduced from this PAT, because unless and until you reduce that, you don't know how much money will be left out for the equity shareholders, correct? So what we do is less the preference dividend. So is that okay? Is it acceptable to all that yes, we will reduce preference dividend when we are finding out the dividend capacity for the equity shareholders? Is it okay? Okay. Next, what do we do? So now we have the profits. Second thing which we need to reduce when we are finding out what is the dividend capacity of the company is debt repayment, share buyback. Debt repayment is different from interest repayment. Please understand that. So whenever you pay any installment, you know about EMIs, right? Equated monthly installments. So being finance people, you all must be knowing that in the EMI, you're not just paying interest. You pay some portion of the principal also, correct? So as per the legal obligations, before paying any dividend, you should ensure that you are repaying the principal portion of the debt on time. you cannot divulge the funds to the equity shareholders without giving debt holders the priority they deserve. So debt repayment actually talks about principal repayment. Yes. Then share buyback. So it can happen that the company wants to cut down on its share capital, right? What is share buyback? Share buyback is basically, one is issue of share capital, opposite of it is share buyback. So the company buys the shares which it had issued out to the shareholders in the past, and then it buys it back and cancels it. Okay, so that is known as share buyback. What it has to do at the time of share buyback? What did it do at the time of issue of shares? It got the money from the shareholders. What do you think will happen at the time of share buyback? It will have to pay money. It will be a cash outflow. So if the company has got plans for share buyback, then that has to be reduced from the profits which will be available for the equity shareholders. See, this is not an obligation, but yes, if the company has got plans for buying back shares, then it needs to ensure that it is done before actually paying any dividends. So share buyback will be paying money to the shareholders, to the existing shareholders, and buying back their shares so that they are no longer the shareholders of the company. Okay. And third is capital expenditure. So capital expenditure is basically if the company wants to make any major acquisition. See, now you'll be able to relate with examples also. When I say that Reliance doesn't pay dividends, why does it not pay dividends? Because it has got a lot of capital expenditure, and that is a reason that it doesn't have dividend capacity. It doesn't have sufficient profits to make payments as dividend. It's not that it is not making profits. It's not that. It doesn't opt to pay dividend because it doesn't have the capacity for it. Why does it not have the capacity? Because it has to incur a lot of capital expenditure. Getting my point? So this is where capital expenditure gets reduced. Okay. So first thing you need to reduce is what? Preference dividend, because that is the legal obligation. They have the preference of getting dividend over the equity shareholders. Second is debt repayment. That principal repayment of the debt should be done before paying dividend to the shareholders. And please understand that this is the principal portion. Interest has already been covered here. Second is debt repayment. Third is share buyback. Share buyback is basically you are buying the shares back from the shareholders and canceling them out. So what do you need to do to buy back the shares? You need to give them money. So obviously that money will come out from the PAT of the company. So that gets reduced. Fourth is capital expenditure. Okay. So capital expenditure is basically, now the example of Reliance holds true. Because it wants to spend more on acquisitions, more on new things it wants to do in the existing line of business, it will spend more on capital expenditure. And that is why its dividend capacity will go down. And we have reduced it here. Okay. So are they making sense to you? Any doubts? Is it clear to all? Okay, great. Okay. So you have reduced these 4 line items. Then tell me, I told you, I asked you a question that is operating expense after depreciation. All of you said yes. So that it is getting covered above only. What do? I have to find out the cash available for distribution to dividend to the shareholders, right? Dividend is what you get money in your bank account. If you are holding shares of some companies which pay dividend, you get it in your bank account. So for getting it in the bank account, the company has to have the cash for it, right? Cash. It's not the profit. It is the cash profit. So tell me, you all agreed that depreciation is a non-cash operating expense. So here it was already reduced. Don't you think I should add it back here? Because it was reduced above, but it doesn't impact my cash flow, right? I will add it back. Are you with me on this point? Do you agree that we should add back depreciation to get the cash flow available for the equity shareholders? Yes. So we are adding it back. Okay. And lastly, if you have raised any share or any debt and you have got money out of it, then also it is increasing the cash position, right? So that also you can add before actually deciding what the capacity, the dividend capacity of the company is. So capital raised from shares or debt. That is what you add up here. So add depreciation, add capital raised from shares or debt, less is preference dividend, less is debt repayment, share buyback, and capital expenditure. What you get as the balancing figure is the free cash flow to equity. Okay, this term we are going to use later in our in one of the chapters, but today you can just know that this is the dividend capacity of the company. Okay, that this is the maximum dividend. It doesn't mean that whatever dividend capacity comes, it has to pay off as dividend. This is the capacity, this is the upper limit to the dividend which this company can pay. Is it okay? Ram is asking, will proceeds raised from issue of shares be allowed for dividend? See, whenever a company comes out with a share issue, it comes out with the proposal, the addendum that this proceeds will be used for this particular purposes. Okay. If those purposes are fulfilled and something is left out, why not use it for distribution of dividend? So it is a valid point. Your better question would have been, can you raise debt and then pay dividend? In India, it is not allowed. But since we are studying an international subject, that is why I've written it as oblique debt. Okay. Some countries, they allow you to raise debt and use those proceeds for paying dividend. It is not allowed in India. Is it okay, Ram? Okay. And I have a text from Pranjal. He says, cleared. I have AFM exam in September, so your old videos will be fine for September exams. And are there major changes in syllabus? See, Pranjal, so you have watched the videos, or how is it going for you? You have watched the June videos? Okay, so just I'll make it clear for everyone. There are not many major changes in the syllabus, but yes, a little tweaks here and there. So if you, Pranjal, if you have not watched the videos, June videos till now, and you're starting afresh, you should always opt for the live classes. Beneficial for you. You can attend the live classes. You can ask your questions directly here. But if you are watching June videos, not a problem. I mean, the syllabus is almost the same. You won't face much challenge there. Okay. So yes, coming back to this, are we good to go on this one? Can you find out the maximum dividend which a company can pay? You can find it out using this table, right? You have the operating profit. If you have the operating profit, then you reduce the interest, then you reduce the taxes. Finally, little adjustments. This is specific only for your finding out dividend capacity. If there is any preference dividend, you would reduce that. If you have any share buyback, debt repayment, or capital expenditure, you reduce that and add back two types of things. Number one is depreciation. Why? Because depreciation was reduced above, but it is not a cash expenditure. We are trying to find out the cash available for equity shareholders. So therefore, you need to add it back. And lastly, if you have raised any shares or debt, that also you can use for paying as dividend. It is subject to the rules and regulations of each country, not specific to all. Okay. So I have a question for you all. Everyone, please open Excel on your laptops or computers, whichever you are using, and try to find out the answer. Okay. Everyone should participate. The following projected financial data relates to CX company. Okay. Now, first, Operating profit is given to you. So you have to find out the dividend capacity of this company, okay? Operating profit is given to you. Depreciation is given to you. Finance charges paid. Finance charges is basically interest. Preference dividend is given. Tax paid is given. Ordinary dividends paid is 60. They have given you how much dividend you have. They have already paid to the equity shareholders. The book value of CX's non-current asset last year was $200 million. This is projected to rise by $40 million. CX company is planning to repay $100 million of debt during the next year. This is your question. Find out what is the dividend capacity of CX company. I have answered your question, Pranjal. Others, please try. Pranjal, I said that there are not major changes from the June attempt, but if you have not watched the videos till now, opt for the live classes here so that you are up to date with all the changes. There are not many major changes from the June attempt. You can choose to watch that. It is completely fine, not a problem. But yes, I would recommend, if you have not watched the videos till now, opt for the live classes because you have the access for it. Okay. And others, please focus on the question. Tell me the answer. So, is it what you're saying, Dhruv, that $100 million will be the dividend capacity? Pranjal, yes, the books are valid. Not a challenge. Chirag says it has a paying capacity of 340 million, of which it is paying 60. So it can repay $100 million of loan. Chotu says dividend is 140. Okay. Okay. So I'm getting a lot of different type of answers. Good that you are trying. I'll show you what the model answer is. And you will feel better off when you find out that your answers are correct. Those who could not get the answers correct, not a problem at all. It's just that you tried and now you will realize what the mistake you made and you'll not make that mistake again. But if you would not have tried, you would never know. You never try, you will never know, right? So it's okay. Let us see what the answer is. This is the answer for you all. Okay. So let's see how the question is. You were given with the operating profit. I constantly made one concept clear to you all that this operating profit is after depreciation. So for any of you who reduced depreciation from it again, I hope now the concept is clear. You should not reduce depreciation again from the operating profit. It is already after depreciation because depreciation is an operating expense. With me? Correct? I hope none of you reduced depreciation again. If you did, now you will remember this part. So operating profit, we took 400. Then we took 330 of interest. Correct? This was given to us directly as finance charges paid. PBT comes out to be 370. See, this is something, this format is something you should actually follow in exam. And that is why I've given it to you in Excel. I will share across this Excel with the class notes also. Okay. So for each of the chapters, wherever there are practical questions, you will find Excel shared along. So, okay, PBT becomes your what? 370 and start making use of Excel, make use of links. Ultimately, that is how you're going to write your answers, right, in exam. So PBT becomes 370. Tax was also given to us directly. You did not even have to make any calculation. It was given as tax paid 75, correct? So you did that. Then you got PAT, correct? PAT is what? 295. From that, now you start making all the adjustments which I taught you just now. That if there is any preference dividend, you pay that first before actually deciding on the dividend capacity for equity shareholders. So preference dividend is 15. Capital expenditure, it had already spent $100 million, right, on this. It wants to repay those $100 million. Oh, I'm so sorry. This is about capital expenditure. This capital expenditure is basically what? Could someone, I saw 140 in a few answers. How did you find out capital expenditure? I've done a small working for you all here. I'll show that to you, but I want to hear from those who said 140 is the dividend capacity. How did you find out the capital expenditure? Very good answer, Rupanshu. Closing plus depreciation minus opening. Okay. Very good. I'm glad you could think in that direction. See, capital expenditure. What I have done basically here is to make a small ledger for you all. I hope you all know about ledgers, correct? So the opening balance was given to us as $200 million, right? It was given, right? The book value of non-current assets last year were $200 million. It is expected to rise by $40 million, correct? So 200 becomes my opening balance. Closing balance is what? 200 plus 40. See, that is how I've linked everything in the sheet, so that if you read the question and you read the answer from here, you will know what is going on. So it is expected to rise by 40. So that becomes your closing balance. And depreciation, in any fixed asset ledger which you make, depreciation is always on the right, right? Because the entry for depreciation is what? Depreciation account debit to the fixed assets. So in the fixed asset account, depreciation will come towards the right. So buy depreciation is 60. Can you tell me what is the expenditure it has made on account of capital expenditure? It is going to be the balancing figure to cash or bank, whatever. It is the balancing figure, and that is 300 minus 200, and it gives you $100 million. Tell me who all did it correctly or who all did not. I think Rupanshu would have done it correctly. Those all, Rupanshu had said 140 as the answer. Chotu had said 140. He would have done it correctly. Okay. No worries, those who did not. I hope now it will be clear to you all. So what did you do? Did you take this 200 million directly as the expenditure or $40 million as the expenditure? What did you do? I am thinking you did 40. Am I right? Because it said it is expected to rise by $40 million. No, that is not it was the book value. See what the statement, I'll come back to the question now, and I'll show you where reading the question becomes so important. The book value is $200 million. Next statement is this is expected. This is projected to rise by $40 million. It did not say the capital expenditure is expected to rise by $40 million. This meaning what? The book value, correct? So the opening book value will be what? 200. Closing will be what? This meaning the book value will be 200 plus 40. Are we good to go on this now? So always make a habit of reading the question very clearly, very properly. So the capital from next is debt repayment. This was given to us directly that it is planning to repay $100 million of debt. That is done. And finally, what do? We add back the depreciation, because I told you, right, above the depreciation was reduced. So what do? We add it back here. So depreciation gets added, and the dividend capacity turns out to be $140 million. Ordinary dividend is $60 million. It means dividend could be increased because it has a higher capacity. It has paid $60 million. It has the capacity to pay up to $140 million. Now, quickly tell me, how confident do you feel in this question now? Any doubts? What did I just do? I taught you how to calculate dividend capacity and with a question on that. So that is how normally the approach in the classes. I'll teach you a concept, then I give you something to practice on your own. We share our answers so you know where you're going wrong. Okay. Is it okay with everyone? Any doubts you feel, no, ma'am, this is not the right approach? Or is it okay with everyone? Can you tell me all? Okay. Okay, great. But yes, please keep up the vigor in the class. Only if you enjoy what you are doing, you will flourish in what you are doing. So please keep up the vigor, keep practicing. It's okay to make mistakes. You are just learning, right? If you're not making mistakes now, then when? It's okay to make mistakes. It's just that after you are done, you should know what the correct answer is, what the right approach is. If you have any problem in understanding the approach, I'm here to explain. That is my job for you all. Correct? So the dividend capacity becomes 140. It has already paid $60 million. It has the capacity to increase it further by $80 million. That is the answer for you all. Okay, so with that, let's take a small break and we will catch up at 12:10. Okay, so see you after the break. Take a refreshment, have a small walk, eat something, and then come back. Okay, see you after the break. Hello, everyone. Welcome back from the break. Okay, so we just completed dividend capacity. Now we are going to start off with what the different type of dividend policies are. You know, each company which is paying dividends, it actually follows different type of policies. As in, some companies prefer to pay the same dividend every year. Some they wish to increase the dividend which it is giving every year. So likewise, every company has got a different policy to follow. Okay. So the first policy, Ramanujam, you have raised your hand. You have any query? If you have any query, you can put it in the chat box. Okay. So the number one policy which we are here to study is the constant payout ratio. What, as the name suggests, constant payout, as in every year the company is going to pay 5% of its dividend capacity. It has a capacity of $100 million. It might have made lots of profits. It has a very high dividend capacity, but it's not necessary that it will have to pay everything it earns as dividend. It has as dividend capacity to pay as dividends, right? So it might have a policy of constant payout that every year it will pay 5% of its dividend capacity as dividends. Okay, so that is number one policy. Can someone tell me what is the disadvantage of this policy? What can go wrong if a company follows this policy? You know what will happen every year? See, the shareholders, see, imagine you would have invested in a lot of shares, right? You as shareholders, you will not keep on tracking how much FCFE, that is the free cash flow for equity, the company is making every year. Correct? It's not your concern to go on reading all of these stuff. You will see that 1 year the company paid 5,000 rupees as dividend. The next year it paid 500 rupees as dividend, because that is what the policy is, right? 5% of whatever free cash flow it is making, it is distributed. This will lead to volatile dividends. Okay, 1 year, so this will create a sense of instability in the mind of the shareholders. Imagine yourself in the shoes of the shareholders now. So 1 year you're getting 5,000 rupees, 1 year you get 500 rupees. Now let me tell you, there are a lot of people who rely on dividends as their source of income. So a lot of retired people, they would have made investments in their young age, and now they just earn dividend income, and that is how their livelihood is. So if a company follows constant payout, 5%, now it knows that, whatever I earn as a dividend capacity, I will distribute 5% of it. But from the point of view of a shareholder, this creates volatility, correct? And this is not something a shareholder likes. Okay, so this is number one policy, constant policy. But yes, few companies follow it. For whom this will be applicable? For companies which have very mature and stable cash flows every year. if it knows that it is going to make approximately 100 to 120 million dollars of revenue every year, it is okay now. Little bit up and down is fine with the shareholders, so they are going to be fine with this. So your status, the company status, I mean to say, decides what type of policy you follow. If it is a stable company, it can follow constant payout ratio. If it is a new company having very high profits in 1 year, low profits in another, it should not follow this policy. Okay. Next is stable growth policy. Again, as the name suggests, first year you're paying 5%. Then, 5% of the share price. So let's say share price is 200 rupees. It has got a policy of paying 5%. So the share dividend it will pay will be 10 rupees. Next year, so share prices also grow in a matured way, right? So next year, let's say the price becomes 220. Here, what it will do, it can set either 5% or it can set a little bit higher percentage, that let's say 6% of 220. Whatever the number is, let's say 12 rupees. So it will pay 12 rupees dividend in that year. So it will show that the dividend amount is growing every year. Okay, so this is a stable growth policy. Okay, it is on the, it can, it depends from company to company, not fixed. As I told you, a lot of things in finance are not fixed. It depends from company to company. Now, it can be on the face value, but what will happen now, if you are keeping it on face value, your growth, in that case, you'll have to increase the percentage factor, which you have kept now, like 5%, I said, 5% of 200, I said. So if you keep it on face value will remain constant over the years now. You'll not be able to apply that 5% factor on an increased base. And that is why either you choose to increase the base meaning the share price, or you can choose to increase the factor. So if you're choosing to increase the factor, then you can take it on the face value. So it all depends from company to company, no fixed rule. So stable growth, what happens in this case? The first year you might be getting 10 rupees dividend, next year 11, next year 12.1, next year 13. Likewise, your dividend grows. And this is a good sign for a shareholder, right? Like for salary. So you get increasing salary every year. It is a good sign for you. You feel that, yes, I am able to live with the inflation also. So this is a good sign for the shareholder. So it sets a level that signals the growth prospects of the company also, right? Next is residual policy. This is basically balancing figure. I would have considered everything in the name of expenditure and everything that is possible. And whatever is remaining after that, residue is what the balancing figure, right? Whatever is remaining, I will pay that as the dividend. So it's like the last of all the types. Whatever is remaining, high, low, I will distribute it with my shareholders. So these are the 3 types of dividend policies which are normally followed by any company. Clear? Any doubts? Okay, do let me know if you are not able to understand something. Please put it in the chat box. Okay, next topic is methods of distribution of earnings to shareholders. First one, which we have been studying so far, is what? Cash dividend. What is the topic? The topic is how you can distribute earnings to the shareholders. See, if you are having a proprietorship concern, whatever profits the concern makes, it's all yours. You don't need to find ways of getting it out of the business. If you're a partnership firm, then you can pay salary to the partners, or you can distribute the partners' profits also. So that is how you can take out money from a partnership firm. Third is company. How can company distribute its earnings to the shareholders? These are the 3 ways. Okay, cash dividend is just one of them. Okay, cash dividend is what? We have studied it so far, all of you know. It is basically distribution of the cash surplus to the shareholders. Correct? Is this fine? Number 1 way how to give out money to the shareholders, that is through cash dividends. Second is scrip dividend. In easy terms, what you will already know. This is nothing but bonus shares. Have you heard about bonus shares? Do you know anything about it? Cash dividend is you are paying cash in the bank account of the shareholders. Bonus shares is you're giving extra shares free of cost to the shareholders. So what are you doing? You're basically distributing your surplus, right? You're distributing your earnings. Not in cash, but in kind. Reliance comes out with a bonus issue of 1:4. That means for every 4 shares of Reliance I hold, I am eligible to take 1 bonus share from the company without paying anything to them for that particular share. So in that case, what will happen? I have 100 shares already. I will get 25 shares as bonus. This will actually lead to my capital appreciation in the long run, right? I haven't paid anything for it. When the share grows in value, I will have higher value in the future. Yes, Chotu, when you say that post-bonus issue value of share will decrease, that is in the short term. But if you see that the company is going to grow in the long run, you will not mind that temporary fall. Whenever dividend is also paid, then also the share price decrease, right? It is known as ex-dividend price. So when the dividend is paid out, then also the share price decrease. That it doesn't mean you don't like dividends. You like getting dividends in your account now, because you know over the year that fall will be replenished with the increase in the value of the company. Similar happens with bonus also. Once the share becomes X bonus, its price falls temporarily. But because in the long run, the company will grow, your value of the shares will also grow. Now I will get that value appreciation on 125 shares rather than 100 shares. So that is how the company has paid out dividend. It has paid out its share of profits. It has given me in form. Okay, that is known as scrip dividend. So easier term, what we all know is basically bonus shares. Dividend payment to shareholders, that is made in shares rather than as cash. It boosts companies' cash flows. Okay, so it is applicable for those companies who do not have enough cash surplus, but they still want to reward their shareholders. They opt for bonus issue. Is it clear? So I hope it is clear to all that yes, the company is rewarding its shareholders through bonus issue. Correct? Then the third way of distributing earnings to the shareholders is through share buyback. We just covered this concept, right? What did I tell you? Share issue is when the shareholder pays money to the company. Share buyback. The company feels that we have so much cash with us. Why not reward our shareholders? Can you give me examples of companies which frequently buy back shares? There's one tech giant which normally opts for share buyback. TCS is what Ram is saying. Amazon, Aishi says, okay. So yes, TCS is famous for buybacks because what it does, currently the share is trading at, let's say, 3,200 rupees. It will announce the buyback at 3,500 rupees. What does it mean? That today, if a shareholder wants to sell its shares in the share market, it will get 3,200 for its shares. But if the shareholder sells the shares back to the company will pay it 3,500 rupees per share. This shows that the company is rewarding its shareholder. But tomorrow, after you have sold the share, you won't be a shareholder anymore. But yes, the company has rewarded you well for being a shareholder for so long. Got it? So that is share buyback. Most people, they tender their shares in this buyback. But normal, those finance professionals who know about share buybacks, they do not recommend opting in for at least TCS buyback. I'll tell you the reason why. Because if the company is paying 3,500 rupees for that share, don't you think this is the value the company perceives in that share? That is why it is offering you 3,500. So even if you do not actually sell them the share at 3,500, maybe in a month or two, maybe in a 6-month time frame, the share price will actually become 3,500. So that, because that is the value the company is perceiving now. So you should be alert, you should be mindful of the fact that if the company perceives that value, it is definitely there in that share, and ultimately it will show in its price in the times to come. So share buyback, yes. Few companies, if you are getting the option to buy, sell the shares back to the company, it's fine. But for a lot of reputed companies, you can choose to avoid, because ultimately you will get the value in the long run. Okay. So that is the concept of share buyback with an example, live one, and that is TCS. Recently also, I mean, like 3-4 months back, it had announced a buyback. So it keeps on happening with, mostly it happens with the tech companies. So what are the advantages of share buyback? It avoids increasing expectations of higher dividend in the future, because the company has laid down the idea that whenever it gets excess money, it will buy back the shares. It will not pay you dividends, but it will buy back the shares from you. Okay. Next is it provides exit route to the dissatisfied shareholders. So when I said, no, for some companies, you can opt for buyback if you get the opportunity. It is for those dissatisfied shareholders. They feel that the company is not doing good. It was a mistake that we invested our money in this share. So in that case, you should actually opt in for the buyback. But for a company like TCS, I believe no one will be dissatisfied as doing so well. So why to actually tender your shares in the buyback? You should keep it in the long run. Third is benefits to other shareholders if the shares are undervalued. Other shareholders, you know what? The shareholders who do not opt in for the buyback. Immediately, I'll tell you what happens. Immediately, when the news of a buyback comes, share price runs. I mean, it actually gallops towards that buyback price. So those people who are not actually going to opt in for the buyback, they are anyways getting the appreciation in the share price now, because that is how the share price works, demand and supply. There will be so much demand for that share that the price of the share will rise, and the people who are going to think that we are not going to tender our shares in the buyback, they will gain out of this. So this is the benefit to the other shareholders meaning the shareholders who are not going to opt in for the buyback. Is it okay? So there are 3 ways by which a company can reward or it can distribute its earnings with the shareholder. Number 1 is cash dividend. Number 2 is bonus shares. Number 3 is share buyback. Is it clear to you all? Any doubts? Please let me know. Is it okay? Can I move to the next slide? Okay, great. Okay, I'm sorry. So this chapter is over. This is the last slide of the chapter. So that is all we have to cover in the dividend decision. So I hope now you all feel a little enlightened about this topic with more data to share, like the different types of dividend policies that company can follow, what are the different methods of distribution of earnings to the shareholders. So that is how it goes. This is a very important topic again, dividend capacity. Can be easily tested for 4-5 marks in the exam, and that is it. Okay, so we'll move to the next chapter now. Okay, so the first chapter which we studied was financial strategy formulation, correct? Now the second chapter in the same section of the curriculum is financial strategy evaluation. So you formulated the policy in the first one. Now you're going to evaluate the financial strategy in this chapter. Okay, so it is financial strategy evaluation. Very interesting chapter. Got a lot of background to tell you the formula also. So you'll enjoy this. Okay, this is financial strategy evaluation. What did we cover in the first chapter? We covered dividend decision, correct? Now we are going to cover financing decision. Can someone quickly tell me in the chat box what all are the different types of decisions which a company has to make? We had a small diagram on that. Can someone quickly tell me? And then I told you that these all we are going to cover in the frequent later chapters. Dividend decision we are covering now. Very good. You're right. Yes, Simar, I refer to the BPP slides and then I my own theory. But yes, workbook you can choose to avoid if you're going through the slides, not to refer the workbook again for studies purposes. You can save your time there. Ram says financing decision, investing decision, and dividend decision, which we have already covered. Correct? So yes, you all are right. Financing decision is what we are going to study now. So company, as I told you, can be financed by equity or debt or both, right? So this is clear. Equity is what? When the shareholders give you the money. So shareholders give you the money without any promise of paying them back. They are taking risk in your company. So when I invest in 10 shares or 100 shares of Reliance, let's say the share price is 2,500 today, I am putting in my 2,50,000 rupees in that company without any assurance that I will get that money back or not. I have put in that money. If the company grows, I will benefit out of the wealth appreciation. Otherwise, I stand a chance to lose everything I've put in the share capital. Correct? So that is what equity holders do. Whereas debt holders, now when I invest in the bonds issued by Reliance, let's say of the same amount, 2,50,000, I get a charge, I get a right on the assets of Reliance. So anytime a company comes out with a debt, it is usually, for all the higher end companies, they're usually supported. The debt is usually charged back to an asset. It could be a building, it could be a machinery, it could be stock, it could be debtors. So these are all secured, mostly. Unsecured debts, normally the companies don't opt for. It reduces their reputation in the market. And people are also reluctant to apply for unsecured debt, because unsecured debt means what? If the company goes down the doldrums, there is no asset to provide you backing for the money you have put in the company. Okay. Yes, Chotu, you are right. So there is no security about repayment. So secured debt. So when I put in my money as a debt holder, what do? I get a first charge on the asset against which that debt has been issued. So if the company is not able to honor its obligations of interest and principal repayment, then I, as a debt holder, have the right to approach a proper tribunal and initiate insolvency proceedings against that company, by which the company will be bound to sell the asset on which this debt was secured and hand me my share of the proceeds of that asset. Okay, so that is how equity and debt are different. I told you, right? Equity, when I'm putting in 2,50,000 in the equity of Reliance, I have no supporting whatsoever to get my money back. Whereas when I'm putting it as a debt holder, I have a security backing. So it is a basically lower risk investment avenue, correct? So a company can be financed by equity or debt or a mix of both. Like let's say 60% equity, 40% debt, any mix which is good for the company. So that you can opt for. So company may be financed by any of these two sources of finance. Each form of capital has a cost which reflects its risk. Quickly tell me whether equity has more risk or debt. Which form of finance has more risk, equity or debt? Ram and Chotu says equity. So I'm getting mostly equity in the chat box. And Harshit says debt. Okay. Think from the point of view of the shareholder now. I just gave you a very good example. I put in 2,50,000 as equity and I put in 2,50,000 as debt. That was secured against the secure asset, right? So that is how their risk is different. So risk is definitely higher for equity. Okay. Now, when I say higher the risk, obviously they will demand a higher return, correct? So the cost return which the shareholder desires, okay, I have put in the money with higher risk in equity. The return which I desire will definitely be higher as compared to the return I expect out of debt. So don't you think the return which I expect is the cost to the company? Agreed on that. What I want to gain will be what the company will have to cost. Is it okay? Right? See, when you get the salary, what is it said? You get some salary, you're making money out of it. And what is it? It's cost to company. CTC is what cost to company, right? That is the cost for the company because you are earning it. But the company, for the company, it is the cost. Correct? So similarly, what the shareholders want to earn out of the company, it is the cost for the company. So if a company is raising either debt or equity, it is going to incur certain cost on it. Equity is not a free source of finance. Just because you have the option whether or not you pay dividends, it doesn't mean it is a free source of fund. It comes along with certain cost, which we are going to study now, okay, in this chapter. And also debt, of course, you understand it has got a cost, that when you pay interest, what are you doing? You're just incurring certain costs for it. Now, visible, you can see that interest is going to be a charge on your profits. That is also a cost. So when I say each form of capital has a cost, is it agreeable to you that yes, even equity will carry some cost? Debt has visible cost in the form of finance interest, which you will pay on debt, but equity also has got a cost. Yes, is it okay with everyone? And when I say which reflects its risk, and that is the reason I asked you whether equity has got higher risk or lower risk. So you all said equity has got higher risk. So definitely its cost will also be higher for the company. Agreed? Any doubts? You want me to repeat it, or you want to hear more about it, or is it okay? Have you understood this part? Please let me know. This is very important to understand that yes, equity does come with a cost. Debt finance also comes with a cost. Okay, so Ayushi wants me to repeat the cost part. No worries. And yes, Ram, for what your question, we have proper topic on that. I mean, where I will be covering what all are the components of cost of equity. So don't worry about it. We have proper slides on it. I'll repeat for Ayushi's question. So she's asking, can you repeat the cost part? Okay. See, when I say this, read this line again. Each form of capital has a cost which reflects its risk. Okay. I told you the concept from the point of view, from my point of view. Like when I invest in the shares of Reliance as equity shareholder, then I've risked my entire money. Did you agree on that? That when I'm putting in 2,50,000 rupees in the company, I have no assurance that I will get it back. I will be the last in the line, last in the queue to get money when the company will be wound up. Do you agree on that, Ayushi? Yes. So don't you think, as a shareholder, now think from my point of view, I'm a shareholder. Don't you think I have taken a lot of risk by providing money to Reliance? I can lose out my entire money, 2,50,000 rupees. Yes, but same money, when I put it as debt, I was backed by certain asset. It could be the machinery, it could be the stock or data, right? There was lower risk because some security was available to back my money. Do you agree with this? Correct? Now you answer my question. So when I have taken a risk, what do I expect in return? I expect reward, return in return. I mean, some return in return. Agreed. That is the reason I will take risk. Otherwise, why will I put money in the shares of Reliance? What is it I'm getting? If I'm not going to get anything out of it, why will I put my money? Yes. So risk comes with rewards. If I am putting my money in the equity, I am going to get certain rewards, then only I will put money. Similarly, if I put money in debt, I'm going to get something in return. So this return which I am getting as a shareholder is the cost for the company, right? If it has to pay me something, maybe visible, maybe invisible, it has to pay something to me, then only I will put money as shareholder, right? If it has to pay something to me, don't you think it is a cost for the company? Correct? Like when you get salary, you are getting some if you're getting something, someone has to give it. Na? The giver will incur it as a cost. So when you get salary, that is a visible, like bank outflow and inflow will happen. In case of equity, it might not be visible. Okay. But you do agree, na? I expect something in return. If I expect something in return, the company has to incur it as a cost. So please understand the fact that yes, equity also comes with a cost. Debt also comes with a cost. Is it okay now, Ayushi? Okay, great. So it's clear to her. So each form of capital. So what are the two forms of capital? Primarily, it is equity or debt. Each form of capital has a cost which reflects its risk. The next question which I asked you was whether equity has more risk or debt. Then most of you said equity. And why is that? Because there is no backing for equity. I may or may not get my money back at all. So definitely the cost of equity will be higher than the cost of debt. Agreed or not? Yes? Okay, great. So we will come to that. We will talk about this in so much detail. By the time the chapter is over, you will yourself start saying that yes, equity is more expensive than debt. But sometimes, normal layman you ask, they will say equity, you don't have to pay dividend. What is the cost? That is the normal people will say. But when you are done with our classes, you will say that yes, equity has got a cost and the company should try to optimize its capital by maintaining a proper mix between equity and debt. So that is the entire chapter about. Okay, so next line is that only debt has lower risk, so it is cheaper than equity. Now I hope you all can understand. Lower the overall cost of capital. Yes, Chotu, it is known as the capital structure. The composition of debt and equity, no? It is known as capital structure. Okay. So lower the overall cost of the company, the greater the shareholders' wealth that is created. In anyways, lower cost is always a boon, right? If you are having some capital in the capital structure, be it through equity, be it through debt, lower the overall cost of capital, then it will be more beneficial for the shareholders' wealth. Correct? So I'll tell you with examples, also with numbers, where I'll show you if the cost of capital is higher, the value which is created for the equity shareholders will be lower. I'll give you with numbers, but I think logically also it makes sense that if the cost of capital is low, the wealth, the money value which will be created for the shareholders will be higher. Is it okay? So if it is okay, we'll move to the next slide. Okay, so now we are going to jump into cost of equity. Ram had a question, ma'am, what is the component of cost of equity? So in the previous chapter, we had one slide where it was written total shareholders return. Can someone tell me, if you recall that slide, what all were the components of that return to shareholders? There were two components. A hint for you. Now tell me, what were the two components? What are the two components of return of shareholders? Ramanujam has answered that. That is the answer to your question only, Ramanujam. That dividend and the capital gain or loss. That is the component of cost which the company has to incur for the shareholders. Yes, Ayushi, you have also given the same thing. Chotu is saying one is risk-free return, another is premium for risk. Oh, yes. So Chotu is telling me the concept which I'm going to teach now. But anyways, what we already studied is that shareholders get dividend and they appreciate capital gain on the share value, correct? So that is the components, visible components of cost of equity. Agreed? Is it fine? This, if this is what the return the shareholder is expecting, this is what the company's cost will be. Is it okay? Please let me know if you're not okay also, but please type it in the chat box so that I can move ahead. So what I'm saying is expected return of the shareholders is what dividend yield and the capital gain yield. For this particular component, this will also be representative of the company's cost. Now, if I have the expectation of 10 lakh salary, then 10 lakhs becomes the cost for the company, correct? That is how the equation is now in any accounts, giver and taker. So it has to match. If I am getting a return of, let's say, 10% on equity, that 10% becomes the cost for the company. Agreed? See, it's a very important topic, so that's why I'm putting in a lot of time. Please do participate and let me know if it is okay. Otherwise, it becomes difficult for me to assess. Okay. So now tell me, there are millions of people who have invested in the shares of Reliance. Okay. I am a shareholder. Let's say you are also a shareholder. I have a certain I have an expectation. I want to make 18% returns from investing in Reliance's shares. Okay. You have an expectation of, let's say, it's okay if I make 10% return overall, including dividend and the capital appreciation. Let's say Ram has got investment. So Ram says, I am okay with 10% investment in the company. 10% return on investment in the company. I want 18%. Then Ayushi wants 12%. Rupanshu wants some 14%. So don't you think each and every shareholder on this planet will have a different expectation of the return from the company? Is it right? Everyone can have different expectations. It's natural because we are all humans. So how does a company find out what is the cost it is incurring on account of cost of equity? Because it's not visible now. What my expectation is, what Ayushi's expectation is, what Ram's expectation is, it's all different. And that is why there was a study which was conducted to find out how to arrive at the cost of equity. Okay. So cost of equity, can I say it is also the return on equity? Now you are aligned, no? What is, for one it is cost, for one it is return. So cost of equity, it is normally represented as K, and in the sub part, it will be E. It is also represented as RE. So do not get confused. These are one and the same thing. KE, RE, they are same. Now you also know why they are same. If it is the cost for the company, it will definitely be a return for the shareholder. Correct? So cost of equity is the return expected by the shareholders. Is this statement making sense to you now? So this has to be calculated. What is the overall expectation of the shareholder? I can't go and ask if I'm a part of the board of directors of the company of Reliance. I cannot go and ask each and every shareholder, what is your expectation? What is your expectation? What is your expectation? It doesn't make any sense, right? So that is why a model was created, and that is known as capital asset pricing model. Okay, you might have heard it, you might not have heard it, but we will start from the very basics in our class here. Okay, so how do you calculate the cost of equity, and why do you calculate it from the cost of equity? We are covering both here. So that is capital asset pricing method, in short known as CAPM. That is what we are going to refer it as, CAPM. Okay, So this model, it was derived after a lot of studies, and it is discussed. We are going to discuss it in stages. Each component will start making sense to you. I'll not make you learn the formula. You yourself will come up with the formula by the end of this discussion. So stage 1, we are going to cover it in stages. Stage 1 is to understand yield on government securities. Okay. Tell me, when you are putting your money with the government, do you think you have any risk? When you're investing in the FDs, so let's say these deposits are issued by government directly. Government of India issued bonds. Okay, Government of India issues bonds. Okay, so please know that from practical standpoint. Government of India issues bonds. Okay, when you're putting, as a normal person, as a citizen of India, when you're putting money in the government bonds, do you think you are taking any risk? No risk. And keeping it in the safest avenues possible. So if you are putting your money with the government bonds, you're going to get the bare minimum return on it. Let's say 2%, 3%. There will be no default risk. Yes, Harshit, you're right. Government will always honor its bonds. Okay. So the return which you get on government bonds or government securities, it is known as risk-free return. There is absolutely no risk when you are investing in the government bonds, correct? So it is denoted by RF, okay? Yes, so RF has got a very low value because you are taking no risk. So why will the government want to pay you high? So this return is known as risk-free return. Investors, now let's say I have two options. I have the options to invest in government bonds, and I have the option to invest in, let's say, the shares of Reliance. Okay. So in that case, what happens? Tell me, what will you expect? Will you expect the same return from both, or higher or lower? Tell me, how will it go? Yes. So I'm getting the same answer from everyone, that we are going to expect higher return from investing in Reliance. Why is it so? Because if I am putting my money in Reliance, it means I am undertaking some risk. What if Reliance defaults? Right? So that is the reason we expect something higher when you are investing in the shares of a company. Correct? That is what is written here. Investors expect a higher return when investing in a company's shares. Okay. Now this will form logically in your mind that if you have two options, and you have the option of investing in government bonds, and if the option of investing in Reliance, you will not invest in Reliance unless and until you get a higher return. Correct? Because you are taking some risk, and therefore you will expect some premium over the risk-free return. Okay. This excess return demanded by investors for bearing the risk is called risk premium. Correct? So you all gave me the concept yourselves that yes, by investing in the shares of Reliance, I expect bare minimum risk-free return, and I want something extra because I'm putting my money in some risk. That extra which I want is known as risk premium. Is it okay? Does it make sense? So can I say the return required by the equity shareholders is equals to risk-free return plus some premium? Correct? So Dhruv has given out me the formula, but yes, we will come to that very logically. Okay, Dhruv? So yes, risk premium is what I want. I don't know the formula yet, how to arrive at that formula. But as of now, we are decided that yes, we will take risk-free return from the Reliance company and also some extra. And that is known as risk premium. Okay. So that was stage 1. Now, in stage 2 of this discussion on CAPM, we are going to understand the different types of risk a company faces. Okay. Please make it very participative. Now, you yourself will start giving out the formula. So, types of risk. The two types of risk a company faces is unsystematic risk and systematic risk. Word-wise, it feels like, what is it? but very logical. Let me explain. Okay, so unsystematic risk has got multiple names. It is known as specific risk. It is known as diversifiable risk. In simple terms, it means that any normal investor now, he doesn't put all his money in just one stock. He behaves rationally. Don't put all your eggs in one basket. What does it mean? That if that basket breaks, your all eggs will be lost. Similarly, if you put all your money in just one stock, you have the risk of losing each and every penny you have invested. So that is the reason it is understood that every rational person on this earth understands that you should not put all your money in just one stock. And that is the basic assumption of this CAPM model, that an investor suffers this unsystematic risk. This is not systematic, this is unsystematic, because someone is behaving irrationally. He is exposing himself to unsystematic risk. Behaving irrationally means he has invested everything he had in just one source. Okay, so an investor suffers this risk only if he behaves irrationally. Sorry, that is, he invests all his wealth in a single stock. Okay, investors can easily eliminate this risk by diversifying their portfolio. Okay, see, now you all are in your 20s, 30s, right? So you will always obviously be investing. Start investing if you haven't, and create a diversified portfolio. Okay, be it in the energy sector, be it in the FMCG sector, be it, all these different sectors which we have an idea of how the country is going to shape up in the next decade, and then decide where you want to put your money. Okay, so this is a assumption which is standard as adopted, that investors are investing in a diversified portfolio. They are not irrational fools, that they haven't all their money in just one stock. So it is understood that unsystematic risk can be eliminated by diversifying the portfolio, and that is the reason it is also known as diversifiable risk. A person will not be exposed to this risk if he behaves rationally. Okay, so that is the meaning of unsystematic risk. Unsystematic risk meaning the person is not behaving rationally. The second type of risk is systematic risk, that is market risk or non-diversifiable risk. It means you do whatever you want to do. There are some risks you cannot avoid at all. Okay, now tell me, when COVID broke out in March 20, what happened to the share market? How much did Bank Nifty fall? It plummeted, right? It just crashed. If there were lower circuits on the index, can you imagine the intensity of that fall? So now you will say that I'm a very rational investor. I invested in this industry. Now my portfolio is fully diversified. Tell me, did you suffer a loss on that day or not? Could you do anything to avoid it? You could not. So do you understand, this risk is pertaining to the market? You cannot do anything about it. It is not diversifiable. Okay, so this COVID-20 crash is a clear indication of systematic risk which prevails in the market, which cannot be avoided by anyone, by whatsoever he might do. Okay, so the systematic risk refers to the risk that will remain even in a well diversified portfolio. So if someone tells that he didn't suffer a loss the day the crash happened, it's not possible. Okay, because the portfolios declined, every share was falling like a falling knife, right? Harshit is asking, for market, should we consider Nifty or Sensex? See, Nifty has got a smaller base, right? Sensex overall has a lot of more companies listed. under it. So it's fine. You can consider either, not a problem. Both of them are representative of the market. Then you also have Nifty Bank, then you have IT sector. So all of these companies are, put together in bunches. So it's okay if you can understand Nifty also as market and Sensex also as market. Okay, Harshit? Yes, so coming back to this topic, that this is the risk which will remain even in a well-diversified portfolio because it is determined by the general market factors. Example, recession. So recession is a more generic term. So we had a very practical, watch out for COVID. We've witnessed that something practically. So this, I hope, will make you understand the concept of systematic risk. You cannot avoid this risk. It affects all stocks in the same direction. And immediately after COVID, after, that 3-4 months passed, the shares started rising. Those who remained invested from that time, they would have made good money. So this was what rebound was happening, and it affected all stocks in the same direction. Fall also happened together, rise also happened together. Maybe at different speeds, true, but yes, they all moved in the same direction. CAPM, the capital asset pricing model, assumes that investors hold a diversified portfolio. Thus, only systematic risk is relevant. Agreed with? Do you agree with this statement? That most investors, they will have diversified their portfolio, so they will not suffer unsystematic risk. They will only be exposed to systematic risk. Now, can I improve my definition of expected return from risk-free plus risk-free premium to say that it is equal to risk-free plus systematic risk premium? So I'm developing it in stages. So now you can say that more clearly, right? Risk-free plus systematic risk premium is what a shareholder will expect. He cannot expect a company to pay him for unsystematic risk also, because if he is behaving like a fool, company cannot compensate for that, right? The company should be able to compensate him for the systematic risk in the market only. Correct? So this is now an improved version of what we deduced in stage 1. Okay. So now we are at this stage. Now RE is equals to RF plus systematic risk premium. Okay. Next is stage 3, and that is beta of the stock. So if you have any queries now, please put it in the chat box. I keep looking at the chat box. So if you have any queries, you can post it. We can get back to the slide and talk about it. Okay. So the third stage is beta of the stock. What do you have you heard this term before? Beta of the stock. Any idea? Okay, Chotu has. Can you tell me, Chotu, what does beta of a stock mean? Yes, Ayushi, that is correct. Banshu is also correct. Sensitivity of the shares. Perfect. Perfect answers from each one of you. You are all giving me different versions of the same statement. Absolutely right, what you all know, but I will inform for the entire audience which we have here. Beta of the stock. So for now, we have to understand that we have to find out the equivalent of systematic risk premium. This RF you can get from the bond market. That today the bond rates are prevailing at, let's say, 2%. So this you can find out from the bond market. How do I find out the value, the percentage equivalent of systematic risk premium, right? That is the question. So how do I find that out? That I need to find out by considering the beta of a stock. Okay. For the purpose of measuring systematic risk, CAPM considers a well-published market index. That was the question, yes, such as Nifty to represent the economy. So Nifty is there in India, then we have Dow Jones in the US, likewise, okay. So CAPM considers a well-published market index such as Nifty to represent the economy. As in, when I say that the Nifty rose from 10,000's level to, let's say, 14,000 today, what does it mean? It shows that economy has grown during this time. Okay, this is what CAPM also considers, that it is considering a well-published market index like Nifty, then the Dow Jones, a lot of other indexes across the world to represent the economy of that country. Beta of a stock refers to the sensitivity of a stock vis-a-vis market return. Okay, you do this exercise, small exercise today, that you will see that the market, overall market meaning Nifty, it fell by 2%. You will see some stocks, they fell by 4%. Some stocks fell by 1%. Some stocks rose. This is the sensitivity which is measured by beta. It doesn't mean, it is not true that, if the market is falling by 2%, each and every stock in Nifty 50 will also fall by 2%. That is not true. I hope you all understand that. If you don't, check out Money Control and find out what happened to the market on Friday. The market fell by, let's say, 2%, but the stocks, some stock fell by higher than 2%, some fell less. Okay, this is what sensitivity of a stock is. Okay, change in stock return by change in market return. So yes, that is what beta is. Okay, so tell me, higher the beta, if the beta of a stock is, let's say, 3, what does it mean? It means that if market moves by 1%, the stock will move by 3%. Okay, in either direction. If market is going up, then the stock will go up 3x. If the market is going down, the stock will go down by 3x. Okay, so it means higher the beta, higher the risk in the stock. Can I say that? If I have taken a very high beta stock, it means I have a higher risk. Now, if this market is going down, it is going to go down by 3x times. So this beta, it represents quantity of risk. As in, if I'm taking a risk in the market, okay, if I'm putting my money in Nifty, I am taking a beta risk equals to 1. If I'm putting a money in a stock which has got a beta of 3, I have taken 3x the time of risk which is there by investing in the Nifty. Okay, that is what is meant by beta. So it represents quantity of the risk. Agreed with this? So what did we start to find out? We started off to find out how to know what is the systematic risk. Now, for breaking down the systematic risk, we brought in a new component, that is beta. Okay, I have a question. Let me read that. How does Nifty represent economic growth? That could be just speculative market with overvalued stock, inflated money supply with no real growth. Okay, that's a good question, Ibani. Yeah. So he has a very delicate question. He says there can be a lot of manipulations in the market, as in the shares could be overvalued, there could be inflated money supply. These are all economic factors which you would have studied in my economics classes. I understand that. But overall, you need to have a representative, right? So when you say that market is growing, it means that normally that is how you should perceive it now. In the US, when the recession hit in 2007, how did someone understand that there was recession? Tell me, what factor did you look at to understand that there was a recession? It was the stock index now. So stock index actually represents the health of the economy, because during 2007 recession, US markets, they plummeted and it had ripple effects across the world, correct? So Ibani says real estate. But do you have a published factor for real estate, which is commonly accepted across the world? Today, sitting in India, we can track how the Dow Jones is going. Can you tell? Yeah, Lehman Brothers was responsible for the collapse, Ibani, but I want to know, how can I judge the performance of an economy which is, across all the countries? In India today, if I look at the performance of Dow Jones, I can understand that, yes, the economy, I am talking about the financial economy, yes, it is growing. Ramanujam is saying real GDP growth. That is a representative of the market, right? So it is all aligned. Now you have to understand you're in the finance books. You have to assign numbers to the facts. So if I am telling you that, market is representative of the economy, that should be acceptable, right? It's not incorrect to say that, yes, market is not reflective of the economy. You will not see a market running when the economy is actually going down. That will not happen. Market will always correct its course. When you say, Benny, that it could be due to XYZ reason, the market is overvalued, eventually market will correct itself. And that is what you're witnessing today in the markets. If you follow Nifty, you will realize every day it is falling. It is not something that the economy is going down. Market is correcting itself. That is what is known as market correction. Okay. So yes, your point of view is very much valid. We need in finance to have a factor to look at, and that is when we decide that yes, we should go for the Nifty index as the representative, because it has the capacity to correct itself if it has gone wrong. Is it okay? Okay. So yes, coming back to the slide where we were discussing about beta of the stock. The beta of the stock is actually the risk in the stock, the quantity of risk, as in by how much the stock will move in conjunction with the movement in the market. So tell me, when the markets turned down during COVID-20 outbreak, which all industries were the worst affected? Which all industries do you think suffered the highest pushback? Transport, yes, like SpiceJet, Indigo flights, all these shares, they collapsed. PVR, Inox, hotels, Indian hotels, correct? Yes, so these are all correct answers which you're giving me in the chat box. So in case of a downturn, there are some sectors which get more impacted. Okay, so obviously they will be having a higher beta. Okay, so now is that making sense to you? When I say that a beta of a stock is representative of the risk, it means what? If it has got a higher risk, the stock will move more. The volatility which it will move, that will be higher. Okay with you all? So beta of the stock is a comparison of the movement in the stock vis-a-vis considered to be 1, and beta of any stock is a number which is representative of that stock's volatility with respect to the markets. Is it okay? Any doubts? Okay, so I'll move to the next slide. So what have we studied so far? Let's have a very quick revision of all the stages we have come so far. So first, we understood the concept of risk-free return. And we realized that if I am investing in the shares of a company, I will expect a premium over and above the risk-free premium. Okay. Types of risk. Now, when I said that there are 2 types of risk, so we deduced that a company should be able to compensate a shareholder for the systematic risk which it is bearing, not the unsystematic risk. A company will not compensate a shareholder for behaving irrationally in the market. So then we said that yes, required return of a shareholder will be risk-free return plus the systematic risk premium. Then came the topic of beta of the stock, that I have to find out equivalent. I have to put numbers, right? Finance is always with numbers. So you have to decide what number you want to assign to systematic risk premium. So when I say that, you all realize that each stock has got a propensity to move in different ways. Some stock, so ITC is considered to be a very stable share. It doesn't move upwards also, downwards also very much. It is a share with a lower volatility. It means what? It has got a lower beta. So if the market moves by 1, it might move by 1.2. So it moves always in tandem. So that is what the that is what is meant by beta of the stock. how that stock is moving in tandem with the market. Okay, so it is a measure of the quantity of the risk which is there if you invest in the shares of that particular company. Okay, and then comes stage 4, and stage 4 is basically your, finally we will be coming to this formula. So please understand that, is there any risk which you face by investing in government securities? Do you face any risk? Is there any beta associated with debt? I told you, right, mostly debt will be secured against assets. So you face absolutely no risk. There is, what is beta? It is nothing but the, as I highlighted here, it is the quantity of the risk. So when I ask you what is the beta of government stock, it is supposed to be 0, right? Because there is no risk associated with investment in government securities. And can I say beta of market portfolio is 1? You have to find out the unique number where to start off with, to decide the beta of a stock. See, whenever you're putting money in Nifty, you understand that you are taking some risk. It's not a zero risk game if you're putting your money in Nifty. If the economy goes down, Nifty will also go down. So you are taking some risk. So you cannot say that there is no risk of investing in Nifty. So to start off with, I assign the first initial to Nifty, that Nifty's beta is 1. Is it okay? Does it make sense? So when I say beta of government security is 0 and beta of market portfolio is 1, this is what I mean. So there is no risk of investing in government securities, hence beta is 0. When I say that you are taking some risk by investing in the market portfolio, you start to assign a number to it 1, and then for each stock which is there in the market, you start comparing it with that 1. Okay, you need to have a comparative for it. So that is known as beta of market portfolio. It means that by investing in market portfolio instead of government securities, an investor is able to make excess return of risk from return from market minus risk from return from risk-free return, basically return from government securities, risk-free return. So this is what happens when you are investing in Nifty. If you are, please listen to this carefully. I'm going very, very slow. If you want me to slow down further, it is okay, but please do let me know if it is not making sense to you. I'm going on little bit stages for you to understand it better. I don't want you to give out this formula, learn it, you will score marks, not in a lot of details. So can I say that when an investor is putting money in the market meaning I am taking Nifty for all practical purposes, when I am putting my money in Nifty, the return which I'm going to get will be equivalent to return from market. Okay, return from market minus the risk-free return by suffering 1 unit of beta. Is it making sense? Okay, so return from market minus return from government securities is the price of risk by investing in the markets because it has got a beta of 1. Correct? So therefore, see, value of anything is what? If you are taking value of 1 dozen milk, okay, and I tell you that the rate of milk is 40 rupees per liter, what is the value of milk which you have purchased? How do you find that out? It is basically 40 into 12, 480 rupees. Then that is what you tell me, right? So can I simply say that if I have to find out systematic risk premium, it is nothing but price of risk multiplied with quantity of risk, right? Price into quantity, any equation, value is equals to what? Price into quantity, correct? So when I have to find out the value, as I said, I have to assign numbers. If I have to find out the value of systematic risk premium, can I say it is the price of risk multiplied with quantity of risk? So price risk, we just understood it is nothing but return from market minus return from government securities, that is risk-free return. If I multiplied it with a quantity of risk, we all agreed that beta represents quantity of the risk. Can I say systematic risk premium is RM minus RF into beta? So if I were investing in Nifty, the beta will be 1, and what I will get is going to be RF plus the excess return of investing in the market. So RF plus RM minus RF, and basically it will be RM, correct? If I'm investing in a stock which has got a higher beta, let's say it has got a beta of 3, it will be what? RM minus RF. What the excess return you desire from investing in the market, I want that 3x, because I'm taking 3 times the risk. Quantity of risk is going to be 3 times. Is it making sense? Okay. I'm getting a lot of yeses. It is a little technical explanation, I would say, but that's how I want you all to learn, to know the reason. Now, if someone asks you, if no one asks you, go on, ask in the market, how is this formula derived? What is the basis of this formula? I'm telling you, 80% will not even know, because they would have just been told the formula, that is the formula. Finding out the return of the equity shareholders, that is all they will know. But now you know the backing. You know why we actually arrived at CAPM, because it is not possible to assess the expectation of each and every shareholder in the market. So we have to assume, we have to find out certain factors which will help us to arrive at the number with proper scientific backing. How did we arrive at that? We first understood that when we are investing in the stock, we are taking some risk which is over and above the risk of investing in risk-free securities. Okay, so that is risk-free return. Then I told you you are undertaking some systematic risk premium. Unsystematic, the company will not compensate you for. So that how to calculate the value of systematic risk premium? Value of anything is what? Price into quantity. Quantity, we understood that if I am taking one value of one risk by investing in the market, and if I'm taking 3x the risk by investing in the shares of Reliance, the beta becomes 3, and RM minus RF is nothing but the excess return I require by investing in that particular market over and above the risk-free rate. When I multiply it with the beta of the stock, I get the excess return which I desire by investing in that particular stock. RM is representative of the market return. Please try to focus on the words I'm using. This is return from market. This is risk-free return. This is beta of the stock, not market. But you should know that beta of any market is, any market meaning any market index is always 1. Okay, and that is how you find out the required rate of return. Ibani is asking how to calculate beta. See, Ibani, beta is basically a composition of business risk. See, I told you at the beginning, right? Beta is equivalent to risk, quantity of risk. And I told you that any businesses, now please try to join the dots. I told you that any business faces 2 types of risks. Number 1 is business risk. Number 2 is your finance risk. Finance risk meaning how you have constituted your capital structure. Business risk is actually representative of the industry you are in. In our curriculum, you will not be required to find out as this business risk, because it is a greater work, as in with a lot of stimulations to find out what the business risk of being in a particular industry is. But yes, we have, since we are in the finance world, okay, we should know what the finance risk is being created because of a certain capital structure. It will come in the later chapters, how to find out beta. There you will learn asset beta, equity beta, it will come. But this beta, please understand, it is including both business risk and the finance risk which this particular company has taken. Okay. So valid question, how to calculate beta? In most questions, you will be given with the beta, equity beta directly. If not equity beta, you will be given with the business risk beta, and then you will have to find out the overall beta. There's a proper chapter on it. I don't want to rush that concept to you now. So please understand that it will be something you will be learning in the chapters to come. Is this statement making sense? Otherwise, leave aside how to calculate beta. Otherwise, is that making sense to you? Everyone spend a lot of time on this to build the entire story around this concept. Please do let me know if it is clear. Getting a yes from everyone. So I'm assuming it is clear to you all. Okay, great. In that case, let's have a small question for you all. Everyone should try a very simple question. Just do a quick math on Excel and let me know. Mantra company has an equity beta of 1.5. Assume there is a market premium for risk of 4% and the risk-free rate is 2%. Calculate Mantra's cost of equity. Now you all know the formula. I'm getting answers already. Okay, I'm getting multiple type of answers. Some is, most of them are saying 8. Ibani is saying 3. I know what mistake Ibani is making. Please think through properly. Most of you have said 8 only, and which is also the right answer. Ibani, just think, read the question again and try to recalculate. Those of you who have answered 8%, you are correct. Okay, so I'll quickly show the model answer for everyone's reference. Very good. Most of you could do it correctly. See, beta was given to you 1.5. When the question said 4%, when you read the question again, that is the reason I did not remove the question so far. The question was, assume there is a market premium. They had given you RM minus RF directly. It is not market return. Ibani, please look at this line again. So I'll present the question again. See, look at this, Ibani. It says there is a market premium for risk of 4%. It didn't say market return. That is the reason I keep on telling you, everyone, read the question correctly. In the previous question, most of you also got confused now that what is the book value of the asset, whether it is the capital expenditure. There is always these little points in questions. Here they gave you the market premium directly. They didn't give you the return. So this is 4%. Now I'll come back to Excel. So RA minus RF was given to you. Market risk premium was given. RF was given as %. Now putting the things in formula is very simple. I'll try to link it here. It's basically risk-free return plus market risk premium into beta of the stock. And that gives you 8%. So those of you who could calculate it correctly, it is a very good attempt. You all understood the concept properly. Okay. Great. Then let's come back here. Okay. So we have covered what. So that was one question, right? That came to me in the beginning of the first slide of this chapter, that how to know cost of equity. We just covered that topic, how to calculate cost of equity. And there was a concept that each component of capital has got a cost, right? So cost of equity, now we know. The next topic which we have to study is cost of debt. Are you able to draw the lines in your head? I hope it is not seeming like ad hoc concepts put together. It should actually draw a line. What we are studying. We are studying about the financing decision. I told you at the beginning, financing decision is basically related to the capital structure of the company. By capital structure of the company, I mean debt, equity, or both. Okay. And then I said that each component of capital structure has got a cost. We just studied cost of equity, and now we are studying cost of debt. Okay. So that story is building up right in your head. Any questions so far? You want me to revisit any particular slide? You're free to tell me that. We can do that. Is it okay? Just give me a thumbs up. If it is good to go, we'll move to the, I'll start off this slide then. Okay, great. So then in that case, let's begin with cost of debt. Tell me, in the dividend capacity table which we studied, did we reduce? Dhruv is asking, will we have various models like Gordon, Walter? Not by names, but yes, you will have these little topics later on in the chapters. But for the timing, let's go with the flow. Don't jump. Let's go with the flow. If this is making sense to you, it's good. We'll not jump here and there. Okay. So yes, I was saying that in the dividend capacity table which we studied, did we reduce interest before calculating the taxes? Why did we do that? Why not after tax? I mean, you first calculate tax on the operating profit, then you reduce interest. Why not that? Harshit is saying tax shield. Okay. No, I mean, not getting the correct answer till now. Not correct, Chotu. Simple, na? Because tax laws allow you to deduct interest before paying taxes. It is a tax deductible expense. Correct? So that is because of the law. Law has said that we'll not allow dividend to be paid before tax. And that is the reason we don't consider it as a tax deductible expense. Similar is opposite. I mean, is for interest. Tax has said that we will allow it to be reduced before actually calculating the taxes. So interest is a tax deductible expense. Dividend is not. Agreed? And that is as per law. In every country, you will find this similar, that they allow interest to be deducted from calculating the taxable profits. Okay. Now let's understand it with the help of an example numbers we will put now. So example, A Limited has $1 million loan on which it pays 5% interest. $1 million loan on which it pays 5% interest. Corporate tax rate is 20%. A Limited's, okay, so we'll come to that. Now let's try to deliberate on this more. When you have taken a loan of $1 million, tell me what is the interest you will pay at 5% interest? Money value, tell me. It will be what? 5% of $1 million, correct? Simple math, no? 5% of $1 million you will be paying off as interest every year. So that is nothing but $50,000, correct? Now, I think I will actually present an Excel to make you understand this better. You all might know this from before, but I'll try to put it in number terms. Okay. Okay. So let's make a small PL account. You all would have studied this in your accounts classes. So let's make a small PL account. Okay. So what do? You put all the revenue. It's a T format I'm making, right? So let's say you made revenue of 100 rupees. You got OPEX of 40. Okay. Operating expenses including depreciation, that is what you got. So tell me, what is the PBIT you have made? Can I say it is 100 minus 40? This is the balancing figure, right? Correct? It is 60. Yes, Rupanshu. Then I tell you that there is some interest which the company needs to pay. And let's say that amount is 20, or let's take a smaller amount, 10. Okay. So can you tell me what is the PBT? It is 60 minus 10, 50. And then the tax rate is 20% of the PBT. And I tell you, it is going to be, let's take a different number. Don't want to confuse you. So this is how it becomes. Let's say the interest is 15, PBT is 45, tax becomes what? 45 into 0.29. So my PAT becomes 45 minus 9. Is it making sense, everyone? Okay. So because of, acha, now what is the tax I am paying? Please remember this figure. I'm going to copy and paste it here. Hard paste. That tax with loan. The tax which you paid because there was loan in the capital structure is 9. I'm breaking it down to the smallest bit possible. So please listen to this carefully and keep on participating. Okay. So tax with loan comes to 9. Now there is a different situation. The situation is that there is no loan in this company. I'm just simply deleting this. What has happened? What happened just now? I deleted interest here. What happened? What changed? Absolutely right, Rupanshu. Tax without loan became 12. Correct? Because I had loan in my capital structure, I was paying $3 or 3 rupees, whatever you want to take, 3 rupees less tax. Correct? Because, so can I say savings in tax due to interest is 3. Can I say this? Savings in tax due to interest is 3. That is, in a little professional term, financial term, that is the tax shield, or I would say interest tax shield is 3. Okay. So what do you understand by this? That because interest is a tax deductible expenditure, you end up saving in terms of tax. Listen to the statement very carefully. Interest is a tax deductible expenditure, and therefore, because of having this interest as an expense, you end up paying less tax to the government authorities. True or false? True, right? That is true. So this saving which comes on account of interest is known as interest tax shield. Correct? So now when I say interest, let's put it back now. Interest is 15, right? That is what I put. Can you tell me, is this the effective cost because of debt, or is it something less or something more? Tell me, what is the effective cost you are bearing for interest? Chotu is saying less. Can you tell me, Chotu, what is the real cost which you are bearing on account of interest? You're right when you say the cost is less. Absolutely right answers, everyone. That is 12. Okay. So can I write interest cost is less interest tax shield, and that is 3. My net interest cost is what? 12. Okay. Just don't get confused with tax without loan and 12. I was trying to put different numbers. Somehow it has come out to be same, but I hope it won't be confusing to you. So this is making sense to you all. Interest cost minus the interest tax shield, net interest cost is what you make. That is the net cost of interest. Okay. So now let's come back to the slide. Okay, now one more moment here. Here I told you with the help of numbers. Okay, I'll tell you with the help of percentages now. Okay. So I hope this is clear. Now, can I say the same thing? Let's say the interest which was there at the rate of 5%, tax is at the rate of 20%. Okay. And so interest is at the rate of 5%, tax is at the rate of 20%. So if I have to put it similarly, can I write 5% here? Interest cost is 5%. Tax rate is 20%. Can someone tell me how do I find out the net interest cost in terms of percentage? Harshit has given me the formula. Others think logically and tell me. Chotu is saying 4. How did I get that, Chotu? Absolutely right. That is 5 minus the tax rate, because there is interest and there is interest being a tax deductible expense. I can write it as 1 minus this, which is your 4%. Is it okay if I say that? This formula is making sense to you? Everyone, please let me know, is this formula making sense? I could have done simply this way also. 5 minus this. 5 minus the tax rate into 5%, correct? But can I simply, if I have to do maths like I mean 5% I take out as common, then I can write 1 minus tax rate in the bracket, no? Is it correct or not? Like it's the same thing. 5% minus 20% of 5. I have written it as 5 minus into 1 minus, I mean, I've taken 5 out as common and 1 minus the tax rate. Correct? So both of these things mean the same thing. No? I've put both of them here. So whenever you look at the slide again, you will know it's just the same thing. I've taken a common out, 5% I've taken out, 1 minus 20% I've kept in the bracket. Basic maths. Okay, I hope I don't have to tell you that. It should be making sense to you. Please do let me know if it is not. I'll still explain. Or if it is good with everyone, do let me know. Please give me a thumbs up or a yes in the chat box if you are good to go to the next slide. Okay, so let's come back to the slide. Okay, now let's read. I am believing you will feel a lot more better now because you have considered with the help of numbers. So let's read it again. A Limited has $1 million loan on which it pays 5% interest. Corporate tax rate is 20%. A Limited's taxable profit will reduce by $50,000, right? That is what we understood when we made that small P&L, that your taxable profit is coming down because you are paying interest. And its tax amount shall reduce by 10,000. There, what did we find out? The tax was reducing by 3 rupees. Tax without interest was 12. Tax with interest was 9. So did we find out? Because of having interest, because of having loan in the capital structure, we saved 3 rupees. This does net cost of loan is what? Interest. Interest was there 15. 15 minus the tax saving was 3 rupees equals to 12. Now I'm giving you references, the example we have studied. So in this entire piece will make sense to you automatically. That is 4% of loan. Quick way of calculating this is 5%, open bracket 1 minus 0.2, that is 4%. Therefore, can I say cost of debt is a very simple formula. It is basically rate of interest, open bracket 1 minus tax rate. I'll show you one more thing over here. Just what is given in this slide, that will also make sense to you. So let's say the loan was of 15 divided by 5%. 300. Loan was of 300, and this is how it is. 300 into 5%. 15. And can I say net interest cost? This is equals to 12 divided by 300. Can someone tell me what will come if I press enter? Quickly tell me in the chat box. What will I get if I press enter here? Yes, I'm going to get 4%. So effective cost will be 4%. Net interest cost, percentage terms, it is 4. I've given out here also. You have given out here as well. Okay. So I hope this concept is clear to you all. Now we know how to calculate cost of equity and how to calculate cost of debt. Correct? Okay, great. So next we move on to a topic. We just studied, right? Government issues bonds. So they pay certain interest on it. This government bond interest is plotted on a graph, and that graph is known as yield curve. Okay, so yield curve, it shows how the yield on government bonds vary according to the terms of the borrowing. Terms of the borrowing means the period of the borrowing. Okay, so 1 year bond will have certain interest, 2 year bond will have certain interest. So likewise, yield curve for a government bond shows what interest we are going to earn on different tenures of the bond. Okay, now have a quick look at this. This curve shows the yield expected by the investor, assuming that the bond pays, very important, please pay attention here, assuming that the bond pays all of the return as a single payment on maturity. That is bullet repayment. Have you heard this term, bullet repayment? Okay, so you haven't, not a problem. It's a technical, or I will say a financial term for meaning that all the repayments for the loan will be made in one shot at the end of the loan. So let's say you took a car loan today of 13 lakh rupees. You have taken it on a bullet repayment model with the bank. And then you are telling the bank that I will pay everything at the end of the loan after 5 years. So this 13 lakh loan, whatever interest the bank is going to charge you, together with all the interest you're going to pay after 5 years in just one single payment. Okay, So let's say 13 lakhs becomes your 18 lakhs payment after 5 years. So that 18 lakhs is the repayment you have made. Is it okay? Making sense? This is a technical term, bullet repayment, but the meaning is very simple. You took a loan today. All the repayments on that loan will not be paid in installments, which happens normally. Rather, it is paid in a single repayment, and that is known as a bullet repayment. Okay, those of you who did not know, is it okay? In single shot, yes. Single shot, when you make the payment, now you can use this term in your normal parlance. It is a bullet repayment. Got it? So, yes, Chotu, correct. This yield curve, when it is made now, it is assumed that when it says years to maturity, that is what is the tenure of the bond. Let's say it is 3 years, let's say it is 5 years. When you're finding out the yield percentage, interest which you actually pay, it will be different. But the yield, the net interest over the years, over the 3 years or over the 5 years, net balance, you know, what do I say? The I'll say average, or I can say overall interest, which this bond is going to give you, that is represented by yield. Okay, so this 3 years to maturity, I'll sometimes refer to as YTM. Okay, correct, because yes, you are right. Yes, Harshit. So when I say 3 years, 3 YTM, the yield is 5.5%. It is understood that you are going to pay interest and the principal after 3 years. Tell me very logically, if you are paying all the interest, all the principal after 5 years, yield will be higher or lower? If the government is paying you after 5 years rather than 3 years, don't you think you will ask for a higher return from the government? Obviously, you are keeping my money for extra 2 years, you need to pay me more. So every year, this is a per annum interest, 5.5% per annum for 3 years, assuming all the repayment is done at the end of the 3rd year. Similarly, 5.8% per annum for 5 years at the end of 5 years. This statement should make sense. And that is how the yield curve is. So if let's say it is a 1 year here, so the interest, the percentage yield will be lower because the government kept your money for less time. So is it okay? Making sense to everyone? So this curve shows the yield expected by the investor, assuming that the bond pays all the return as a single payment on maturity. This is an assumption, and that is how the yield curve is made. It is standard across the financial world. Please let me know if this is making sense to you all. Okay, great. Now, another small topic, about, again, this is for relating to cost of debt only. So next is credit rating. Have you heard this term? Do you know each one of us also has a credit rating, which you might have heard as CIBIL score? Yes, each bond also has a credit rating. Okay, so a company, it has got a reputation, right? Like, let's compare Reliance with a very small company. I think you can take any normal listed but small company. Let's IBUL Housing Finance. Okay, so both of them are little different. Like, Reliance has got a very high reputation in the market as compared to IBUL. Agreed, now? IBUL Housing Finance. So these two companies have different reputations in the market. When each one of them comes out with a bond issue, do you think people will apply for both of them with the same excitement? Or people will be more interested to apply for Reliance or more interested for IBUL Housing Finance? What is going to be the perception of the public? So everyone is telling me Reliance will be preferred. Why did you say that? What is it that people will go running after Reliance bonds more than IBUL Housing Finance bond? Because of good credit. Who was it who said that? Let me go up. Chotu. So Chotu says because of good credit. Another word is right, the reputation, which you all are using. This is what the topic is about. Credit rating. Okay. Each company has its own credit rating, and with that, each bond also which it issues now, each bond also has got some credit rating. For example, Reliance only. Now we all have come to the conclusion that yes, Reliance's credit rating will be higher. Now Reliance also issues 5 types of bonds. Bond A, Bond B, Bond C, Bond D, Bond E. Each one of them have a different asset backing it. Bond A is supported by very super quality building of, or let's say land and building of Reliance. Bond B is supported by a very old piece of land which is not very clear. I mean, which is not having a very high value. So each bond has got a different asset backing, right? I hope you can understand what I'm trying to say, that the quality of the asset which is being backed, which is backing that bond is different. Okay. These factors will contribute to a different credit rating for that bond. Bond A will be definitely superior than bond B because the asset backing which this bond A has is more. Am I right? So first we understood between Reliance and IBUL Housing Finance. Second, we considered within Reliance, there are 5 types of bond. Each bond is supported by different assets and the quality of those assets are also different. I told you that bond A is supported by a very high quality assets. Bond B with a lower quality assets. So tell me, out of these 2 bonds, which one will have a higher credit rating? Bond A or bond B? Right? So all of you are telling me it is going to be bond A. Correct. So that is what the objective, my objective here is to tell you that each bond has a different credit rating, which is determined of a lot of factors, including reputation of the company, including its profits, including its asset quality, all of that. Okay. So a bond's credit rating also affects the return required by that investors. Okay. Now tell me very quickly, when I'm investing in the, now you told me that you will go and prefer Reliance bonds, but IBUL Housing Finance also wants money now. That is why it has come in the market to raise money through bonds. Tell me whether IBUL will offer the same interest on its bonds or higher or lower than Reliance. All of you are telling me higher. Why is it so? Why are you telling me IBUL should? Both of them are coming up with bonds. Both of them are listed companies. Why should IBUL offer? Very good answer, and that is because its credit rating is lower. Because its credit rating is lower, it means it has got what? Higher risk. Risk comes with rewards. If I am putting my money in a high risk bond, I will want money, extra money in return. Correct? And that is what is known as required return by the investor. The first line should make sense to you now. A bond's credit rating also impacts the return required by that investor. Okay? Because IBUL has a lower credit rating than Reliance, you started demanding a higher interest from IBUL. Is it right? Making sense? Great. So lower the rating, Lower the rating, higher the risk, higher the investor's expectation. Very simply put. Now you can understand it logically, understand with the help of examples, okay? Lower rating, higher the risk, higher the investor's expectation. Now there are certain standard definitions of bond ratings, okay, which was given out by Standards and Poor's. It's a rating agency. It says, these high level bonds, when there is a rating like that, you should understand that the bond has got excellent quality and has got the lowest default risk. Here, similarly, as the rating goes down, the definition also goes down. It is a good quality, low default risk bond. Medium rating and BB or below, it is basically junk bonds. Is it okay? This definition is making sense to everyone. As the rating goes down, the quality of the bond is going down, and they BB or below bonds are known as junk bonds. Don't have to remember it. Don't worry, I'm not asking you to remember this table, but this table should otherwise make sense that higher the quality, higher the credit rating, it is denoting a higher quality bond. Okay, are we good to go? Okay, so that is the concept about credit rating. Now we'll come to the financials in the next class. We are short of time now, so I won't take it up now. It's a little complicated, so we will take it up in the next class. I hope whatever we discussed today is clear. Please let me know if you have any queries in the next class. Ivany, AFM lectures, this is the same slot, like weekend, Saturday, Sunday, 10 to 2 is what we are going to follow. Say all the weekends. Yes, Arshid, next class is tomorrow, same time, 10 a.m. Please do come, please do attend. And any queries, welcome to share. Okay, I hope you had a good time. Thank you all for attending so patiently. See you tomorrow. Bye-bye.